think we're good now. Great. So hi everybody. This is John Clancy again, and we're gonna get going again on the financing infrastructure TA webinar TA. And I thought I'd do, I think I mentioned at the end of the last session, is just kind of just walk through relatively briefly what we've covered so far and try to highlight what I think are the key points to take away. And Bill and Mark, please jump in if I'm missing something you think we should kind of highlight. But as you probably recall, we started the discussion with organizing for development, a section on that. And the first part of that was looking at organizing a development team, which usually includes someone who's in charge, which might likely be the executive director or like an assistant director role or someone like that, or perhaps a development director. You have that for your projects. And then also having someone on the financial side, someone on the legal side, and then someone on the grant side, basically, of things. And the grant person and the legal person could obviously be in-house, or a lot of times, you have an outside counsel, or you might, on certain grants, want to have an outside consultant help put the grant together, especially for more complex grants or ones that are a first-time thing. I guess one thing to point out there, though, if you do that, you'll probably want to, though, keep good records of what you got together from that consultant, because it might be in the future you can do it yourself. There's grants that are competitive. All these grants, basically, that are competitive truly are competitive. So you want to write very good submissions, and some are more technical in nature, and that's where you might bring someone like that in. We also talked about, for the development team, it can also be important for actually getting the grants, especially from, I guess actually from all the grants we've been involved in, especially the HUD ones. There they look at who's involved in your development team, basically, and what are their skills and how they've been involved in recent relevant and successful projects. So I think building your team, actually, especially if you're newer to this, actually also helps you to get the grants. It is a little bit of a it's a chicken and egg problem, I guess, that the more you do of this, the more you'll have successful projects, the more you'll be able to use those projects to explain to the agencies, the granting agencies, why you will be successful on these kinds of projects, and that helps your score. But I think it's also important, if you're getting going, you look back at the work you've done already. It may not have been grant funded, but if you've done any, like it's in an energy area, any energy efficiency or renewable energy work at all that's been successful, you want to keep track of that kind of stuff. And any housing development work, even if it's not under let's say a HUD, ICDBG, or the new LIHTC competitive grant, you'll want to keep records of that to just show what you've done. So you can explain that in your grant application. And then we also talked about forming and implementing a development plan. That is probably good, just to kind of look through again when you have time on the steps involved and what how you're pursuing projects. The big thing that stands out to me, though, is that in that area is making sure that you can kind of balance things out. You want to make sure you're obviously pursuing projects that are the ones that the housing authority wants to pursue, and because it's the need, it preserves the members appropriately, and is good for the housing authority too. But you also have to obviously think about where the funding sources are coming in, and a lot of times you can just, in a little bit of a way, tweak your projects so they'll score well and do well. And one thing that comes up more recently now is a lot of this climate change kind of stuff that's coming on, and they're looking in the grant applications to get at least enough bonus points where it could mean getting the grant or not. But a lot of that is really just making sure that the infrastructure and the housing you put in is resilient to storms and things like that. And then secondly, that it's energy efficient and potentially has some renewable energy aspects. And since the grants can help pay for a lot of that stuff, and there's a lot of overlapping grant opportunities, for instance, we'll get tomorrow to the DOE grants and things like that that are more energy focused in particular. Those things can actually be used to help meet the cost share on either side, essentially from from the HUD, that has the money, for example, being used together with DOE money might work well together on a project and work out well. So just being aware of that, being aware of what are the key issues for grants, but also always having the first eye, I think, on, making sure the projects actually make sense for you all as you go forward. So there's a little bit of a back and forth thing. You have to be thinking about that as you go forward as well. We then talked about the legal background related to the development of these kinds of projects. And we first talked about the federal Indian law and tribal law that applies. The three key issues we covered were the jurisdiction, tribal jurisdiction, and there, your projects are typically done by you as the housing authority, or perhaps the tribe or some other tribal entity, and contractors. The key point there, I think, is that under the Montana test, the Montana exception, actually, that for basically contractual relationships or consensual relationships, that the tribe does have jurisdiction over those, and that's so you want to be aware of that, so you're not giving it away in your contracting. The ability for the tribe to regulate that activity. You should be just aware of that too, generally. That's the kind of your projects are in the category that should be able to be under tribal regulation because of that, as long as it's not given away in the contracts in some sort. Then with respect to sovereign immunity, which we talked about, the housing authority should have sovereign immunity. The only issue probably there is if you have an older ordinance that was used to establish your housing authority, and it still has this, that there's a consent to sue or be sued language in the ordinance, that probably needs to be looked at and addressed. Otherwise, the key issue probably is, the key issues, I guess, probably are, one, making sure that, your contracts, when you sign them, don't waive sovereign immunity. And a big issue there, I think, is really if you're getting contracts from others, which is typical, from your contractors, their form contracts, they may not even be thinking about it, but there may be language in there that waives sovereign immunity. And may waive it much more fully, in much more full way than you'd be willing to do if the negotiation led to a limited waiver. So that's one thing to be aware of. Another thing to be aware of too is just, that sovereign immunity is not a bulletproof shield, that there's ways for folks to at least argue that it should be limited or not applicable or whatever. So, and as I mentioned, I think we discussed that typically if there's a lawsuit that comes out of a contract and there's a sovereign immunity issue, that's raised as a defense right away before the case really gets going in full. But it's usually litigated, which means that the other side is thinking about arguments as to why it doesn't apply. So you have to, I think, when you're entering the contract, obviously it's pretty obvious, but just make sure that you're thinking about the fact that you may have a sovereign immunity defense, but you should be writing the contract as something that you would adhere to anyways. And so you'd want hopefully get to go down the road of these kinds of issues anyways, of whether there's going to be a dispute or not. And then on the federal approval side of things, I think the big thing there, probably the most relevant thing, is the issue that if you're going to have any, especially leasing or something similar to that of land, and you don't have a Hearth Act ordinance, that's when you're going to, have to likely go through BIA for approval, which adds time oftentimes. So it's if you don't have a Hearth Act ordinance, it's important, I think, to be in good contact with the BIA about your land use issues, since they'll be more involved, and that could lead to some delays, especially for, this was probably most relevant is for low-income housing tax credit projects, where you're going to have a separate entity that is where the housing authority is typically a partner in it, probably the general partner or general, the one that kind of runs the company essentially, but still it's a separate entity. And in fact, the investor is typically like a 99-point-something% owner of the entity, so that the tax credits can all be monetized. So because of that, you'll need to have a lease typically, and if you don't have a Hearth Act ordinance, you'll need to be thinking about proper contact with BIA about the project and making sure you can kind of go forward successfully in a time-effective manner, in a timely manner on your project, despite the involvement of BIA in the project that way. And then after that, we kind of rolled over into, the tribal kind of infrastructure. And again, probably the biggest issue there is again, thinking about whether there should be a Hearth Act ordinance if there isn't one on your reservation. That's obviously something that the tribal council would make the decision on. But if you're looking at doing a a number of tax credit projects, or if just in general on the reservation, there's a lot of discussion about, bringing partners into projects. Typically, that means there's a separate entity, which means that there has to be a lease of the property to them if they're going to own the project, and then that's where the Hearth Act ordinance becomes, much more valuable. It can also be for, just leasing out stuff where the tribe's not, it's a separate third party too. That can be important, but that's probably not quite as relevant to housing. Where it really comes up a lot is tax credit stuff, for low-income housing tax credits, and somewhat for energy tax credits, which we'll talk about tomorrow. And then the other ordinances can be very helpful, making sure you have good environmental ordinances and perhaps a utility ordinance and even commercial contracting type ordinances. But the one that really probably stands out if you don't have it is probably the Hearth Act ordinance. It's important for you guys to know whatever environmental ordinances you have so that you can work with the tribe effectively on review of your projects. But the key thing is probably the Hearth Act ordinance to be thinking about with the tribe. We then talked about, the legal infrastructure related to right-of-ways, and mostly because it's assertion of tribal jurisdiction over these right-of-way areas that's allowed now because of the recent Obama administration rules. And really, frankly, the biggest thing is the ability for tribes, especially tribes with a fair amount of land that might have a lot of, utility right-of-ways going through them, to generate revenue, which can be really key for both tribal operations, but then especially for housing authorities to have funds available through the tribe, perhaps for the cost share on these grants, and like for tax credit projects too, for cost share, and that essentially are filling in the gap of financing. And that can be, really important, because we talked about these grants, a lot of them are now have gone to be more than 50% and be, significant grant amounts, but typically there's always still a cost share, or at least a required, a scoring for leveraging. So having more money available is obviously helpful, and especially for these cash injections, especially if we're thinking about this as like one of the general themes of this financing webinar is, what can you do beyond or to leverage your NAHASDA block grant funding. And so you can just use that in a targeted way for as needed for your operations, and for, for leveraging other grants too. So you can kind of build from there rather than rely so much on it or be trapped by it, essentially. We then, after we went through the organizing for development and legal background, we went through the financing of infrastructure. And I think, kind of the key points there are, one, the NAHASDA money is obviously available for that, but you want to use that in a very targeted way. If you use it probably at all for this, so you can have you can use it for leveraging of other grants, basically, and things like that, and have money as available as needed for injections of funds to get the things done. But if you can, kind of leverage that with both the ICDBG grant, which is very flexible and is focused on infrastructure in a lot of ways, so you can use that to help build out your infrastructure. You also we also talked about the IHBG competitive grant, which is probably more focused on housing, and as far, when it first came out, was really on new housing, but could also be used for infrastructure related items as well. And so it should be thought about for that. And both are substantial grants now. It's $7.5 million for the competitive IHBG, and $2 million or more for the ICDBG, are the caps. And so I think it's making it more competitive to get these grants, but it also makes them so valuable that you really have to be thinking about how do we make sure we're in line, at least if it's not every year, at least regularly, to be thinking about going after these and hopefully getting them. And then we also talked a little about the ICDBG imminent threat grant, which is mostly, it's a good thing to be aware of, mostly in your mind, just in case there's a major event that occurs on the reservation that's kind of essentially area wide and causes a problem. It's most important to be aware of that right away, because you probably want to go to HUD right away if that occurs, because it's kind of a first come first served grant. So they should be kind of an immediate thing to think about if there's some kind of almost like FEMA-like disaster or problem that occurs on the reservation, or the kind of problem that's kind of spread throughout the reservation. You didn't really expect it. It's unique, but be ready to go to them, to HUD, if you have any issues like that. We then also talked about, if you're financing infrastructure, obviously the thing you want to do is get as much grant money as you can and use in things that you don't have to return the money for, that's not a loan or debt. But there are important multipurpose loans to be aware of. One is the Title VI program for your NAHASDA money, where you can get, up to 5 times the NAHASDA needs portion as basically as a guaranteed loan, where you're guaranteeing it though, with your NAHASDA money and getting money from the federal government, as opposed to the federal government guaranteeing it. And that again should be used by strategically and only, on a limited basis, but can be an important source of funds if you're looking to do projects and you need some extra money, especially if it's on a short-term basis and you have a plan to pay it back. You need to have a plan to pay it back outside of your NAHASDA money. That's going to be required anyways, but you want to do that so you're not putting your NAHASDA money really truly at risk. You are somewhat, because you're guaranteeing the loan that way, but where you have another way of paying it off is what you want to do for that, if you want to consider that one. The second loan grant program is the USDA Rural Development Community Facilities program we talked about. That one can include grant money, but a lot of times a lot of loan money that comes through instead. We noted though that USDA is really one of the second besides HUD, is probably way up there in terms of agencies to be connected with, because they also, I think, help work with you to find other sources of funding and are good resources that way. And then just they may have a fair amount of money for a project that, if it's a community facility type project or things like that you could get funding for. So they're also important to know about. And then we also talked about tax-exempt bonds, which are complex. This is probably only if you have a large debt portion to a project and it's a large project with a lot of money at issue, because then the advantage of it is getting lower interest rates because it's tax exempt. The interest is tax exempt to the investor or the lender, but they're complex, and so that's only probably for real big projects. We then went over new market tax credits, and I think that's another thing that's probably mostly important if you have a big project. If you have a multi-million-dollar project, and perhaps even above 5 or 10 or higher millions of dollars, because in the end you probably get, I'm guessing, 15 to 20% equity. I know, as I mentioned, I'm on a board for Ecology Center that's doing a big project in the inner city of Milwaukee, and it's, I think, getting basically about 20% value out of the new market tax credits. And so it's really helpful, because it helped close that last 20% on the project to get it done. And I think at the point now they have 80% of the other money, so that works out well. But it's complex. It's really for things that are not straight housing, but it could be housing plus other real estate development, and it could be other kind of real estate development stuff that goes on. As long as you're in a new market tax credit eligible area, is probably the key issue, which a lot of tribes are. And as I mentioned, you can do searches on the web for new market tax credit areas, and then put in your location and find out if you're in that area. So it's an important thing to be aware of if you have larger projects and you have a gap in your financing, and you'll want to then get connected to what's called a CDE, a community development entity that's either works with tribes, like Travoid does direct work with tribes only, or could be others that would be interested in your project. When we were working on a project for a tribe, I was pleasantly surprised at how the various entities were very interested in the various CDs were very interested in talking to them, and actually want to put the tribe's projects as examples of what they wanted to do. So that it can be great if you're connected to the CDE that's interested in your kind of projects, that can be really valuable. The water and wastewater stuff that Bill covered, I think he just put in the chat links to some of the resources he was talking about there, so you have those. I think the big message there is that if you need to work on water and wastewater issues, the good news now is that with the Infrastructure Act, as well as other funding that has occurred recently, tends to be more money available in the past. So that's good to be aware of if you're looking at building out your water infrastructure and wastewater infrastructure. So if you are interested in that, I would probably especially do a couple of things. One, go through the slides again and think about the different types of resources available. Also look at the handbook that's in the links to you guys, and check that out further, and then get involved with the various contacts at USDA, the Rural Utility Service, and EPA and IHS, and just start talking to them about what's available. Since I think if you're looking at needs in the water infrastructure area, there are more funds available than the past. So that's great news. The last thing we talked about, or I'm sorry, the second last thing we talked about for financing infrastructure was the BRIC program, the Building Resilient Infrastructure Program, it's an interesting grant because I think every tribe should at least be looking at that. That may be more at the tribal level, but the housing authority may want to talk to the tribal if they're looking at applying for that. Part because there's a $25 million tribal set aside. The things that are easier to fund are the kind of mitigation planning itself, which is important probably for any tribe to have anyways. And then money left over from beyond that for the actual projects, and that can be helpful if you can start to think about what are the resilient aspects of our infrastructure or kind of community type projects, whether community centers, a center where people can go to during a storm or a heat event, that kind of stuff, anything for elders, especially on heat issues. You might want to think about that's another potential source of significant amounts of funds. So I think it's worth at least checking out, especially if you've already got yourself going and we know where we're at on the ICDBG and the competitive IHBG and some of these more fundamental grants to housing. It's important to be aware of something like this as well. And then finally, in the infrastructure area, we talked about broadband, and Mark talked about both kind of how broadband works with the different types of basically broadband infrastructure. And then probably most importantly, the fact that there's, kind of a record amount of money now being made available by the feds. It's early on, which is in some ways good because it's all become available. The one issue is that the programs aren't fully developed. But it probably makes sense for you to find out within the state in which you're located, if you guys need to upgrade the broadband on your reservation, or you think you could use that, especially in your house for your housing, to be in contact with the state agency or agencies that historically have been, the ones that provide, this money from the feds out to grantees, to make sure that you understand how the program works, make sure it's being developed in a way that works well for your tribe and for Indian country, and then be ready to go after that money, especially as you're building out your infrastructure. And you might be putting that at the same time as you're putting in roads, things like that, and other lines to make sure you can have funding to pay for that. And that's it, basically where we are now, except for we just began a little bit the financing of rental housing. And I was going through the general grants again, which are, the key ones, the same three HUD grants that are key to be, on top of there. Your HASDA money being available for that, but then trying to, again, limit or basically have other funds too, so you can leverage that money rather than have it be limited. And then the competitive IHBG, being especially important for housing, especially for new housing, because it's really the first kind of major grant directed at tribes that's for new housing, but also can be used for other things like rehabbing housing. And it's, again, a lot of money per grant. So it's extremely valuable if you can get that. And then the ICDBG is the same kind of thing, but that's more for the housing area for just housing rehab. We also noted that you could probably leverage a lot of the costs for these projects, especially they're, either energy efficiency projects that include energy efficiency elements if they're rehab, or they're new and they're highly energy efficient, and perhaps have some renewable energy features by thinking about a couple of things, thinking about other federal grants, which we'll go through in detail on tomorrow, but also the state and utility funds that are likely available in your state. Most states have a program either directly from the utilities or through the state or a quasi-state agency that provides funds for energy efficiency and potentially renewable energy projects that could be incorporated, and that could be help meet the leveraging requirement, or to score well on leveraging to meet the up to 25% leveraging, for for those 2 grants to maximize your score, that those could also be funds that could be valuable to think about for that. They may not pay for the full 25% extra. They may actually go beyond that for housing rehab projects, if it's mostly energy related, and if you have a good program, especially for lower income folks in your state. But it's important to be aware of those things to help meet that leveraging and then to save your NAHASTA money as well that way. We also then talked about the Federal Home Loan Bank AHP program and the fact that there's really 11 of these regional banks out there covering different parts of the country. They all have their own program. They're all somewhat similar. Some programs may allow you to be outside the region and apply for them, but you probably especially want to make sure you're aware of the one in your region and aware of a bank that you could partner with, a member bank you could partner with to put in an application where, as I mentioned before, the actual applicant is the bank, not the regional bank, but the member bank. So if your bank is a bank obviously in the area, and if it is a member bank, it probably makes sense to talk to them. If not, you need to look at the list of banks, or you should look at the list of banks on the at the regional bank's website and see if there's one that makes sense to be talking to about this stuff. And the big issue here is that it's really an opportunity to get another kind of HUD-like grant, in the sense that it's for housing. It's particularly for lower income housing, and there's some more stringent requirements on income that you think about for that and how you structure your project. But it's a fair amount of our clients have gotten those, and they've been very, very helpful in terms of helping to fill in basically and provide additional money for their projects. A lot of times these AHP grants are also used in combination of low income housing tax credits, so that can be important too, to help meet the remaining costs on those kinds of projects. So all that can be very, very helpful. And then now we're up to current. We're just finishing out. We were just finishing out the AHP program. This last slide here, notes that you have to maintain it as affordable housing for 15 years to have that, to not have to repay any of the subsidy. So, and then I think, let's see, I need to, let's see where we go from here. So, so the last kind of more general grant program that we'll talk about, and then we'll switch it over to some more particular programs, is the home program. This was created as part of what's called the Cranston-Gonzalez Act, which is, I guess the formal title is the National Affordable Housing Act of 1990. So it's the largest block grant to state and local governments for housing for low-income households. So it's really an important program. We have one client that we worked on a project where they took advantage of this, and they were able to get a significant amount of funding through the state of New York for home loan grant, basically, or the equivalent of a grant that was used for the development of elderly and housing for homeless veterans. So it was very valuable to them. It allowed them to finish out the funding on that project. And this grant program is, its primary purpose is to expand the supply of decent and affordable housing, really focused on rental housing and for very low income and low income, Americans. So it's a program that, again, you definitely have income restrictions on, but it can be very valuable, probably because it's another bucket of money beyond the HUD money that could be used on projects, and especially where you have gaps in your funding, basically. Actually, not sure. Hey, Mark, you should advance to the slide if you don't mind. I seem to have problems on my computer. So it can be used for a wide range of purposes that are housing related, including, acquisition of sites, acquisition of properties just in general, rehabilitation and new construction. It can also be used for rental assistance and administrative planning costs, and the operating expenses of what are called CHODOs, which are community housing development organizations. I'll talk a little about what those are. And if you're seeking funding under this, you'd probably want to talk to the state agency that's responsible for administration of home program funds and confirm whether you'll need to form a CHOTO or not. I think our client was somehow able to avoid this issue, but it's not actually right now completely clear to me how that we were involved in the overall development project, but they brought this funding in. So home funds can be used to assist multi-unit projects. In fact, that project was a multi-unit. It was I think an 18-unit. It was a one-story facility, but it was multiple units within it. And so it can be helpful that way too, where some funding might be limited to single family or up to four units. And then Mark, just the next slide. And so the assistance can be in a lot of different forms. It can be like as a loan, or sometimes a forgivable loan, sometimes deferred payment loans, grants. It could be a form of equity investment, it could be an interest subsidy, it could be a guarantee of third-party loans. So a variety of forms of assistance that are approved by HUD, which is the agency this comes through, but it's not through the HUD ONAP office. And so on that project, I think it was a loan that basically went away. So it was kind of like new market tax credit financing, where you have a loan that's forgivable and tends to go away in the future. But it can be in a variety of different forms. I think that also depends on how the state wants to structure the program that you're applying through. And then, so typically, this is what I mentioned before, typically tribes and TDHEs don't themselves qualify as CHOTOs, but they can form a CHOTO. But they'd have to be a situation where no more than a third of the CHOTO's board members are officials or employees of the tribe. So you have to have somewhat of an independent board for that to work, and for the CHOTO. And I think, again, this is an issue. If you're interested in it, you'd want to talk to the state about how you need to structure your project to make it work, because I think each state might be a little bit different in how they implement this aspect of the program. And the next slide. Thanks. And this is a program which it's underutilized in any country. In large part, it was underutilized because state financing agencies were assuming the tribes were excluded or could be excluded because they had the NAHASDA funds, but that's not true. You do need to meet how the CHOTO requirement is applied, but you can structure projects and be a tribe or tribal housing authority and receive the funding. So again, it's a very valuable program. There's a lot of money available. I think it was a couple $1 million that flowed through to the tribe we worked with on this through the home program. So it was very valuable. But it often takes a lot of education, a lot of time, or it takes time in communicating with the state agency to make clear that, hey, we should be eligible. How can we make it work? And that's what that tribe did, or that housing authority did. They worked with the state agency. The state agency realized that can work. You can apply, and you can receive the funds. So the idea is really to be in contact. If you do a search for home program or home funds, and your state you're in, you'll probably receive the information about the agency that implements the home program, and then you just want to work with them to see how it can work for your tribe or your housing authority, what you need to do in your structuring, and then go forward if it makes sense to you. If it it's mostly a financial thing. If enough money can come through, it makes sense to think through your project to make it work. And I think that's it. Mark, what's the next slide? Great. So at this point, I think I turn over to you.
Me.
You. Yeah. Okay, go ahead.
Yeah. Thanks, John. And so thankfully, we get to stay in the same universe here. We're still talking rental housing, under the larger umbrella of housing projects and housing programs. But this subtopic is specifically about the demographic, who will be seeking the certain types of housing and rental housing that you're looking for. So, I'm going to cover grants for specific types of tenants, and it will have essentially an overview of 3 programs. There we go. So we're going to discuss 3 programs: the HUD Section 202 supportive housing for the elderly, the HUD Section 811 supportive housing for persons with disabilities program, and then the HUD VA, which is Veterans Administration Supportive Housing for Veterans Program, VASH, HUD VASH. And just thinking about supportive housing generally, there's usually 2 significant elements. There's one, we're talking about subsidies, so it's grant money to help reduce the costs of developing and operating these types of rental units. And 2, supportive housing means services provided to the tenant in those units based on their particular needs, and usually a mechanism to track how you're maintaining supportive housing services. So in this case, these 3 categories are kind of self-explanatory, which elderly, disabled, and certain veterans. So like double click. Did I just do twice? No. Sorry. So we'll start with the elderly program. It provides capital advances. That's what HUD calls them, but they're basically just grants. And these capital advances for elderly people aged 62 and over or a very low income. And that means under 50% AMI or area median income, which is a term we use over and over again for determining eligibility. But funds can be used for the development, rehabilitation of existing housing or rental assistance subsidies. So it's both new development or rehab of existing facilities. And supportive services typically include things like cleaning, cooking, transportation, nurse visitation, services of those sorts that are of need for elderly. And then the amounts of funds available depends on the annual appropriations by Congress. And that is something that we look for and can track, but it's sort of one of those programs that is dependent on an annual appropriation. So we talked about how these capital advances are essentially loans that function as grants. I can't advance the slide. There we go. Because the advance never needs to be repaid so long as the housing remains dedicated to elderly low-income people for at least 40 years. So that's a fairly long time, but these are interest-free capital advance loans that are never asked to be repaid because it is for a highly specific purpose. Another important component of this program is rental assistance. So rents can't exceed 30% of adjusted income, which is typically insufficient to finance operating costs. So you have to make up the difference somewhere. And Section 202 rental assistance provided under the program covers that difference. So, and that's the delta between the rental income generated and the operating costs for certain services. So, and in our opinion, this program has been underutilized. Tribes and TDHEs cannot directly apply for it, which is and it requires a go-between entity such as developing a nonprofit. So that's where you sort of need to think about this ahead of time, Steve. This is something you'd like to explore, but eligible applicants can be a 501c3 nonprofit housing developer. That's where we've seen the most success for these types of programs. And tribes typically disfavor having tribal members served in projects that are not tribally owned and controlled. But that being said, some tribes have successfully partnered with these nonprofits to develop housing for tribal members by providing a low-cost lease and entering into contracts for the tribe long-term that provides supportive and or administrative managerial services. But a glaring weakness of this program is that Congress has typically underfunded it. So it's one of those chicken and the egg issues. It's underutilized, and whether it's underutilized because it's underfunded or usually if there's more interested projects that aren't getting completed because of the underutilization, then that would drive more funding. So doesn't mean that it's not worth pursuing. It's certainly a unique thing. If you have this need in your community, this may be a good fit. And we can, after this presentation, I'll share some links to notice of funding available, the most recent one, to give you a flavor for the size of these types of projects. And you can always look into examples and maybe in your area or nearby to learn more. So turning to the second category of the specific types of rental programs or rental housing programs. This is the Section 811 Housing for Persons with Disabilities program, and it's really a twin program with the preceding topic we just covered. The structure and operation of this program is very similar. There's income eligibility rules that are the same. And then the capital advances and having rental assistance services component work the same. So the tribe would need to partner with a nonprofit developer under an arrangement where the tribe provides long-term lease contracts to provide managerial or other support services in order for this project to go. But instead of elderly, it's people with disabilities. But key to that, there's definitions that you should be aware of, whether this is a program you want to go with or you have eligibility here. And that is the three-part definition for what is a person with disabilities. So one, it has to be someone determined to have a physical, mental, or emotional impairment that is expected to be of long, continuing, or indefinite duration. And two, that the substance that impairment is substantially impedes his or her ability to live independently. And three, that impairment is of such a nature that such ability or inability could be improved by more suitable housing conditions. So the impairment definition is fairly broad, but then you sort of have to make the case that there's a need and someone's life would be improved with this service. There's some other topics on this we could touch on. The capital advances we covered this in the last program, but can only be made to nonprofit organizations, and tribes may qualify as project sponsors for application of rental assistance, so long as they meet the project sponsor criteria as established by the State Housing Finance Agency. All right, so the third and last supportive housing program we're going to discuss is the HUD VA, often called the HUD VASH program, which serves homeless veterans and their families. And the idea here, again, is, as is the case with these other supportive programs, is to provide funding for housing and to provide on-site services to tenants to address particular needs. And the idea is vets are often homeless because they don't get services that they need. Then they lose their homes or they encounter addiction problems and there's no treatment and there's no services available for them, or they may be far away. So a supportive housing model, there needs to be a case management program for each tenant. And it gives some examples in the slide here. There's at least one facility like this in each of the 50 states and DC, Puerto Rico, and Guam. So there are some examples that are available where you can learn more about these types of facilities. But just to give additional background and some pros and cons with this program, tribes have had difficulty accessing the general HUD VASH program because it requires involvement of the VA, and tribal reservations are often remote from VA services. So Congress has authorized a demonstration project specifically for Indian country, which is fully subscribed now, as discussed in the slide, so back in 2015. There were initially 26 participating tribes, and that was increased by another half dozen or so. That allowed the tribe to partner with the VA to jointly provide supportive services to veterans. And you have some facts here. Grants range from $100,000 to almost $400,000 grants where tribes partner with the VA. And the HUD rental services may be tenant-based or project-based. So it can be very minute and have it be by tenant, or it can be a broader base. No matter what, though, you would need those specific case management support for veterans to qualify. So there was a new round of funding, bringing us up to current date. Well, there. New round of funding was announced, but unfortunately applications were due just days ago. But the funding itself was 2.2 million, 2.2 million. So it's the increasing in available funds. Most of this money will be targeted towards tribes that are already operating tribal HUD-VASH programs. It's expected that HUD will make 20 awards under this notice of funding opportunity. And the tribal HUD-VASH program has a lot of support in Indian country. And there are proposals to make this program permanent. Again, it was sort of it's still on the trial level introduced in 2015. But it would be great if this was permanent, because then it would establish a steady stream of funding for tribes to operate their own HUD-VASH programs. So to summarize some of the what we covered today, and I'll share a link regarding this following this presentation, but all three of these specific tenant programs are more complex and more advanced because they all require that third party that may be, you have to partner with. Then maybe the tribe may be unaccustomed to working with a nonprofit in this manner, or the nonprofit may not be accustomed to meeting the needs of tribal members with specific needs. But despite these obstacles, some tribes have successfully accessed program funds to meet these special needs of their elders, vets, and these programs are worth considering. So interested tribes should reach out to nonprofits in their areas that work with these programs and see if there's an opportunity to collaborate. With that, that reaches the end of that overview of specific types of tenants. Mark, I am unable to advance this slide. Mark, can you advance the slide?
Yeah.
Sorry.
All right. Whoopsies.
Oh no. You're gonna have to reshare and
Yep.
come back.
Is that better?
Now we see it. Yes.
Okay, we're back. Thanks for bearing with us on our technical difficulties here. Okay, so next we'll talk through some loan programs. Some of these, we've touched on briefly before, and John, kind of summarized that earlier. We'll be discussing the, see if we can advance here. The Title VI Guarantee Program, the HUD Section 184 Loan Guarantee Program, Section 515 Rural Rental Housing Loans, and the Section 538 Multifamily Housing Guarantee Program. So first, the NAHASDA Title VI program, which comes from Title VI of the NAHASDA Act of 1996, which is, again, the basic block grant program that funds affordable housing in Indian country. Title VI is a special feature of the law that gives tribes the flexibility to leverage their block grants with a U.S. government guaranteed loan. The idea here is that the lender, who has a 95% guarantee from the federal government, would be far more willing to lend on any project with the risk being minimal, provided that the lender, follows all the necessary rules. If the tribe can't repay the loan, is unable to repay the loan, the lender simply turns around to the federal government and asks for the loan to be repaid, up to that 95%. So a couple catches to this program. Developers of affordable housing in Indian country need to be aware that there's a limit on how much borrowing capacity the TDHE has. The max amount that can be guaranteed under a Title VI loan is 5 times the TDHE's total Indian housing block grant, minus the amounts needed to maintain existing housing stock. As a rough estimate, rough number, this often comes down to taking the needs component of the grant and multiplying it by 5, although even that's sometimes a higher number that can actually comfortably be accommodated. With that limit in mind, it has to be used judiciously because the housing authority, of course, needs its block grant funds to operate its existing housing stock. The other catch is that this is not a grant. This is a loan, so it has to be paid back. Part of the program requires that the TDHE pledge its future block grants against repayment. So if the lender has to call on the guarantee and the federal government has to make good on that and repay the lender, the federal government is simply going to garnish future Indian housing block grants to which that TDHE may otherwise be entitled to. So pledging those future block grants has the added disadvantage of reducing the amount of money that you could have available in the future to meet any new development needs. There's also underwriting associated with this program, which means that HUD won't automatically guarantee the loan. You have to put together an application package demonstrating that there's a source of funds to repay the loan. The TDHE must then demonstrate it's experienced in complex financial transactions, usually requires a resolution from the tribal government, since the Indian housing block grant that is being pledged against the loan belongs to the tribe, not to the TDHE. HUD will want to know that the TDHE has the ability to repay the loan without impairing or blocking the future use of NHASDA block grant funds. So with these drawbacks in mind, the Title VI, guaranteed loan program can still be really valuable. The best use is probably when a tribe or TDHE is putting together a large, multi-million-dollar, multi-unit project, talking 20, 30, 40, 50 units, and the numbers are falling just a bit short, and you need that $500,000 or a few $100,000 that you haven't been able to quite find. You can plug that gap in with the Title VI guaranteed loan. Then if you later can find a source of funding, you can pay off that loan. At least you can get your project built. It's good for those purposes. The next program we'll talk about is the HUD Section 184 program. This has been HUD's kind of signature loan guarantee for some 30-odd years. Section 184 refers to the Housing and Community Development Act of 1992. And this program offers lenders a 100% U.S. federal government guarantee. The loan proceeds can be used to purchase or rehab an existing home, purchase manufactured housing, or construct new housing. But it's only available for single-family homes or multi-family units up to 4 units. They can be located on tribal trust land, allotted trust land, or fee simple land in an Indian area. So either an individual member or a tribe or TDHE is an eligible borrower under the program. The Section 184 program was initially intended to address the problem that lenders didn't want to provide mortgage loans to tribal members on trust land because you can't foreclose trust land. So the best use they could get would be a mortgage on a long-term lease from the tribe to a tribal member. So the 184 program, giving the lender a guarantee, was thought to be the solution to that problem. In fact, the 184 program has largely been used off reservation, and Indian areas have been expanded to cover, in some cases, large urban areas where there are a significant number of tribal members. So while the program is targeted at home buyers, tribes themselves are potential eligible borrowers, and this can be significant because a tribe may want to do a 24-unit project, and it may want to give its tribal members a rent-to-own option. And to do that, it can use individual Section 184 loans. So we've seen this with some tribal clients, and maybe John can provide some more color on that. With up to 48 units, 48 different Section 184 loans guaranteed by the federal government. And as the tribal members become credit eligible, they can assume the loan. So these are projects that involved, in addition to that hard Section 184 debt, very significant subsidies from other sources, including tax credits and Federal Home Loan Bank so that the amount of the hard debt that the tribal member would ultimately assume is very favorable and far, far below what a home buyer would pay off reservation for the same type of housing.
Hey, Mark,
Yeah.
I see that we have a hand raised from Tyson Thompson. And John, if you're available, there we go.
Tyson, do you want to unmute and?
Yeah, feel free to unmute, and if you have questions, you can either raise them like this, or you can also put them in the chat too, so.
Yeah, my question is kind of really quick. On back to the Title VI, instead of garnishing our allocation from IHBG, could we use non-program for the guarantee?
This is John. I don't think you can use it for the guarantee, but you could use it for the funding source. In fact, what you want to do is never tap into that guarantee. The idea is it's just a guarantee. It's not how you plan on paying for the loan. Actually, that it makes sense. You might use your program income as at least your initial backstop against that. You may also, in the meantime, try to find even other funds to pay.
Oh, I mean, not using program. I mean, non-program. So
No, I'm sorry. I meant non-program. I'm sorry.
Yeah.
But yeah, I think that what you'd want to do. This is a program that's, based. The guarantee is the reason why they do the guarantee. I believe, at least, is that HUD feels comfortable doing it because they're the ones that actually control your NAHASDA block grant. So if you didn't pay the loan back, they could just keep part of the block grant back, in a given year when you're supposed to be paying it back. But I guess what I'm saying is that you could use your non-program income as your plan to pay it. So the idea is really never to tap into the NAHASDA block grant, but you need to have it up as a guarantee in case you don't use your other funds to pay HUD back. Does that make sense what I'm saying, or does that answer?
yeah, so and if we use non-program and then locally through the tribal government, we can use civil court to gain that money back.
Yeah, so you might have almost like a double guarantee in a way, or a double payment plan. You have, if things really went haywire and you didn't even have your non-program money, you could pay the guarantee if needed, but you want to do this, but NAHASDA or HUD could hold back the NAHASDA money. You could also have a secondary payment plan of using your non-program money, and then also a real primary plan of using other money that you already get in from other sources. It could be from the membership they owe money, or it could be other funds to pay off stuff. But I think that'd be a great idea to be, kind of double protected there that way too, to make, because you don't want to look bad with HUD and have to tap into the NAHASDA money, frankly, I don't think. And you also don't want to, you want the NAHASDA money available for your operating expenses and for whatever is left over for projects and stuff like that too. So that.
Yeah. Okay, thank you.
Oh, sure. Thanks for the question.
I think we were here. Yeah. Okay. So we're going to touch on the process a little bit here. So the tribe for the Section 184 loan, the tribe first negotiates the loan with a commercial lender, and the lender needs to be HUD approved for the program. The lender is the one that then applies to HUD for the guarantee. The lender, of course, at that point has a leasehold mortgage where the loan is made for the home on the reservation on trust land. So to participate in this program and to make it available to tribal members, tribes have to enact the appropriate legal infrastructure, that John has mentioned before. That means a leasing ordinance, mortgage foreclosure ordinance, and potentially even an eviction ordinance, so that in the event of a default on the loan, the lender has options and the federal government has a means of repossessing that home. So most tribal mortgage foreclosure ordinance will give the TDHE a right of first refusal, or another tribal member a right of first refusal. Having a foreclosed home end up in the hands of a non-member never happens as far as we know. There is some bother involved for a lender in getting certified by HUD and to make those Section 184 guaranteed loans. tribes and the TDHEs should kind of press their bankers to become qualified to issue the 184 loans. Particularly, these banks are holding the tribe's deposits, so it's good business for them, and it's appropriate for them to reciprocate in and go to a little bit of trouble to become eligible to make these Section 184 loans to tribal home buyers. So the next program we'll touch on is the U.S. Department of Agriculture's Rural Development Section 515 Multifamily Rural Rental Housing Loan Program. So under Section 515 of the 1949 Housing Act, the Rural Housing Service of Rural Development can make loans to tribally designated, the TDHEs, the tribally designated housing entities, at a 1% interest rate for new or rehabilitated low-income rental housing for families whose income doesn't exceed 80% of AMI, or the area median income. The program hasn't spurred new development in recent years. The appropriations have gone to maintaining existing 515 projects. It's unclear if Congress is going to fund new construction anytime soon. But this is a program that is potentially extremely valuable, and some tribes have successfully used it. It comes not only with significant grant for construction, but also involves project-based rental assistance, which is in a lot of cases absolutely crucial to the success of a project. Rental assistance means that if the ability of the tenant to pay rent is limited, then the rental revenue is going to be inadequate to meet the operation cost of the project. The Section 515 program can provide subsidies to cover that difference between the rental revenue and the operating cost of the project. So again, extremely valuable, and it's worth a tribe's effort to form that relationship with your state's rural development office. Every state has a rural development office under USDA, and within the rural development office, there are different programming desks, including the Rural Housing Service, which administers that 515 program. Certainly valuable to form relationships with USDA officers in the state office to make sure that you're in the loop in the event Section 515 funding becomes available. The next program we'll talk about is the USDA Rural Development Section 538 Guaranteed Program, also part of the 1949 Housing Act. The 538 program, though, is not a direct loan program like the 515 program is. There's no government loan, just the federal guarantee on a commercial lender's loan. The good news here, though, is that the program can be used to finance housing for tribal members whose income exceeds 80% of area median income, up to 115% of area median income. The rents are capped at 30% of adjusted gross income, or AGI, and this program could be used for large multifamily rental developments. The tribe or the TDHE would negotiate the terms of the loan with the lender, and then the lender applies to the USDA for the guarantee. It is a 90% guarantee of the total development costs in the event of a loan default. So the lenders still have that 10% risk factor. There's an initial guarantee fee under the program. It's pretty small, and annual for that annual guarantee, it's 0.065% on that initial guarantee fee on a $1 million loan. So on a $1 million loan, that'd be $6,500. And on a $1 million loan, there'd also be the annual fee of $3,500. So the USDA takes into account the size of the population being served, the need factors, and leveraging. It's also important if the project has tax credits associated with it, something they're going to look for. They will emphasize kind of 3 to 5 bedroom units. You get more points for larger units, as they're trying to get housing to as many people as possible. Extra consideration also will go to locations on tribal lands. and a long-term commitment, which is, never a problem for tribes. Some developers are for profit and not mission driven like a TDHE. And are, as soon as they can, they want to flip the house into a commercial project. So for tribes, that's almost never the case. So just to kind of summarize where we're at here on multifamily rental programs, the Title VI guarantee program is pretty easy to use and especially usable for that gap financing. It's not going to drive a project, but might be just what you need when other sources fall a few $1,000s short, $100,000 short of that goal. The 184 program, normally for home ownership, but does have a role in the development of multifamily rental to the extent that it can be used for a rent-to-own program for tribal development to be turned over to the tribal members when they become credit qualified. Again, the 515 program, it can be a major project driver, but again, that congressional funding piece has been unreliable. The best strategy here is probably to form a relationship at your state rural housing service office within rural development within USDA. Make sure you're aware of any Section 515 funding that may be available or will become available soon. And then lastly, again, that Section 538 program is especially super helpful if you have a large rental project and you want to serve some members whose income is between 80 to 150% of AMI. And there may also be some interest rate subsidies available depending on those income limits. So now we'll turn it back over to John to touch on a few other programs.
And John, did you think this would be a wise time to take a quick break?
Yeah, I think this is a good time to take a break if that's okay with everybody. Well, why don't we come back at 30 past the hour? So right about 15 past the hour, and then we'll continue on with we'll go on to the low-income housing tax credits at that time.
And
Thanks, everybody. Oh, go ahead.
Mr. George had a comment in the
Great.
Just and this could be clarified later or now, but I think it's more of a clarification and point out of expectation for the 184 loan. The draw occurs earlier than you'd expect, so the payments on the construction loans are due right away, as opposed to a normal construction loan where the draws are usually in the future. So just something to keep in mind, I think, strategy-wise and expectation-wise. But I don't know if there's a specific follow-up question, but that's an important point to note. So thanks for that comment, Mr. George. If there's a follow-up question, please let us know.
Great, and we'll all come back at half past the hour, if that sounds good. Thank you very much. Hi, everybody. We're back now to talk about the both the competitive and what's kind of the non-competitive low-income housing tax credit programs, and why to be aware, why to think about both, and how to think about both, and kind of how both could potentially help you. So with that, Mark, can you just go to the next slide? It's not working on my end, I think, this for some reason today. So I think you're all aware of low-income housing tax credits. The questions are, how to use them best, how they can be valuable for you, how they're also complex though too, and what to make of all this, and so you can be kind of smart in your use of them, and just aware of how much work will be involved in making them work. So low-income housing tax credits, have really been the primary engine for low-income housing development in the United States. As noted in the first bullet, they produce or preserve, meaning they help develop new or help rehab existing homes in a tremendous quantity, 6.7 million low-income housing units basically since 1986. So it is the primary driver for both Indian country and the rest of America for low-income housing. And a lot of tribes now use them and have used them for actually quite a while now, at least, for both new units and rehabilitation of existing units to bring better housing in Indian country. But as we'll talk about, the program's complex, is competitive, and therefore you need to dedicate a fair amount of resources if you're going to pursue projects in this area. It also has more stringent income limitations than HUD housing does. So you have to think through how can you make this work and make sure that housing is reserved for the people of the right, essentially the right income levels, or especially the right average income levels. And so the 9% program is called the 9% program, or the competitive program, because it's, it provides a 9% tax credit to tax investors who invest in low-income housing projects. They get the 9% of their investment back as a tax credit each year for 10 years. So it's very significant, the funding. It's really a 90% tax credit. When you think about it, it's 10 years of 9% tax credits. It's spread out over time, so that the kind of time value of money of it is not 90%. It's less than that. It's probably about 70%, but it still covers really kind of the vast majority, or the majority of costs for a housing development, a low-income housing development. And that's why so many folks try to use it or use it. Next slide, please, Mark. So the big thing is that it's a very valuable program, but it's also quite complex and it's quite competitive. So that's what you're kind of weighing here, is that you have a program that's both very valuable for projects, but also complex. And it's complex in two ways. One is that it operates like a complex grant in terms of an application for the credits. So the credits are federal, but the programs are administered through the states. So you need to know what is a relevant office in your state that basically allocates the tax credits, and those allocations are then made on a competitive basis. So in that way, it's like the new market tax credits we talked about before, that there's a limited supply of these credits, and there's a lot of folks that want to get them. So the projects have to submit on a competitive basis to get the tax credits assigned to the project, to the housing project. It's somewhat different than new market tax credits we mentioned before. There you have a kind of standalone CDE that applies for the allocation, and then then itself goes to the projects. Here, your project would go in an application for the tax credits, and the state is then reviewing those projects and seeing how it scores compared to the criteria the state sets up, which is probably driven by the feds. So it's competitive and complex that way. That it's also complex beyond that, in the sense that there's a complex transaction with the investor, because in order to what they call monetize the tax credits, you can't have the project just like owned by the housing authority and then sell the tax credits to the investor. The investor has to be a partner in the project. So you'll need to set up then an LLC or an LLP, typically oftentimes an LLP, a limited liability partnership, where typically the housing authority is the general partner, so it's the one that kind of runs things, and the investor is a limited partner. But the limited partner investor typically owns 99% plus of the units in the project, or the membership or the partnership units in the project, because you want to have them get 99% of the tax benefits, especially 90% of the tax credits that flow from the project. And as I mentioned before, that the 9% credits, when you add it up, it's 90%, but it's received over time. So and then the investor needs to make a profit on what is investing in. So typically it can cover about 70%, or perhaps somewhat more. Probably not more now because of higher interest rates, which then increase or decrease the time value of money for things coming in the future. but they can provide, a very significant amount of the funding and well over half the funding for a project. So that's why, again, it's so valuable. So you're kind of caught in this a little bit of a catch-22 here. It's not totally catch-22, but you have to decide, do I want to go through this process to first apply for the grant or the tax credit allocation, which is like a grant, which is like a competitive, a complex grant that's competitive, and then have to enter into a complex transaction with the investor. The good thing about it, though, is that there's folks that can help, put together the tax credit application, and there's also can be development fees to the housing authority as basically the developer of the project. So a lot of these costs can be covered, especially if the project, the allocation request is successful. But it does take a fair amount of work to get this done. And that's why, I think there's been some hesitancy by some housing authorities, but a lot of the ones are saying, hey, let's go for this because it's really the biggest source of money we can bring in for projects. So that's why it kind of goes forward, though, still. The other thing, I guess, to think about, again, we'll get to this in a couple slides down the road, or maybe the next one is the income limits, because you have to be thinking about that too. How do we properly fill this project with people in light of the income limits for the low-income housing? Next slide, please, Mark. So this is kind of repeats the same concept I talked about. Because the 9% credits are so valuable, and since they're limited supply, it's quite competitive to get them. So you have to be, thinking about your application. It's not just an application where you can submit it and say, I got a pretty good chance of getting it. You have to make sure that you're meeting all the scoring criteria set forth in the what they call qualified allocation plans that the state housing finance agencies put out. So you want to be very aware of what they're looking for. A lot of it now has become more sustainable development related, and has various features that you want to make sure that you're on top of, and make sure your homes incorporate those features. So it's bottom line, it's really important to know the scoring criteria. It's probably important to know it well ahead of time. And even if you're working with a consultant, you want to be talking back and forth. How do we best, meet these criteria? Because the whole point here is to get the tax credit allocation, but also then do it in a way that doesn't cause the project to fail to meet if there's critical needs you have for your project or critical ideas of what needs to be done. So that's, again, that same kind of balancing that occurs on grant applications too, making sure you're understanding the scoring criteria, doing well in the scoring criteria, but also making sure the project meets the needs of the tribal members and the housing authority and the tribe, and what its goals are. And then there's the last point here again, that, a lot of tribes end up working with consultants on this one. It's an example of, you always think we gotta have someone in the grant, a writer role always, and sometimes that person is in-house, and then sometimes it makes more sense to say, hey, let's bring in some outside expertise because this is a unique or complex grant application. And also one of those things where the outside consultant can perhaps also train your inside people so that they can, become more adept at those kinds of grants and go after that money themselves over time. Next slide, please. So then the kind of related issue is that you got 70% of your project funded. How do you project fund the rest? So this is a list of things of resources that some of our clients have used to help fill that gap. Because you do need still, it's not like it will cover the 100% of the cost of development. And then secondly, because this is a tax credit project, low-income housing tax credit project, and since you're filling units with lower income folks, because of that, the amount of revenue that you're gonna be able to receive from the building is the homes or the buildings is quite limited. So you really need to, kind of fill in the gaps on funding the remainder of the project, which is kind of a general thing I think we've been talking about a lot in these presentations in general, that it's important to be thinking about how do we piece together the puzzle to get everything covered. So you think about it, you have NHASDA, block grant money that could be put into the project. You could go after a competitive IHBG grant that we've talked about quite a bit. That would be very valuable for a low-income housing tax credit project as well. Also, the Title VI loans we talked about could be available. ICDBG has been used as well. And then you can get the various forms of loans and loan guarantees could be used to help fill that gap. And then, the water, sewer, and stuff like that, the grants and loans could be used to the extent they're considered part of the same project. A lot of folks look at using Federal Home Loan Bank AHP funds in this context too, and you got the home funds we talked about before. That's more generally available that are beyond tribes, and then also I mentioned before, there's both state and significant federal resources for energy efficiency and renewable energy that could also be used to help fill in the gap. But you're gonna have to, kind of work. It's an iterative process in terms of how do you fill in that gap and make sure things covered. Oh, next slide, please, Mark. So this is the issue about, who can be in the homes and how to make sure you're meeting the income limits, and then making sure this actually works for you. We've had some of our tribal housing authority clients have done some low-income housing tax credit projects, and they say that that's as much as we can do because we need to make sure we can fill the units with people of appropriate incomes, and we might not have enough, or we feel a little bit hamstrung in terms of what we're doing with too much of the low-income housing tax credit projects because of the substantially lower income level that's required for these kinds of units. So it's real important to think this through too, and how it fits into the overall portfolio of projects. So basically, there's a requirement that the low-income household in this context means income not more than 60% of the area median income. So it's significantly below the 80% standard for HUD. The income compliance, fortunately, is determined when the tenant moves in, not necessarily if they, you don't need to necessarily kick them out if they go above the level. So it's more when they're brought in, but still it's an important issue as tenants turn over and stuff like that, making sure you're bringing in the right income level folks, basically. A qualified low-income project historically has meant either it's 20% of the tenants have income under 50% AMI, or at least 40% of the tenants have income under 60% AMI. So those are additional requirements that have historically been required, which also then created complexity, I think, in terms of how do you fill these units in. But now they have also changed things to allow for income averaging, which permits like a 60% ceiling of AMI for the average of all the units being filled in, basically. So there's a little bit more flexibility now, but it's still, the big issue is that you're filling these units with lower income folks, even lower income than your HUD units. So you need to be thinking about, how are we going to allocate folks so that we're not going to get in trouble in this area. And it's a big issue because the tax investors, their primary concern is making sure they don't lose the tax credits. So they're going to have basically guarantees and indemnities required, most likely, of the housing authority, that they will make sure that the folks meet the income criteria. Because if you don't meet the income criteria, then the state and its audit can raise issues, and ultimately they could lose tax credits, especially going forward, or perhaps even recapture those tax credits initially if they found out that it was something that's wrong historically. So this is a key issue that you're going to want to be thinking about as you're doing projects, looking at your portfolio basically of folks that need housing, and that make sure this can all work out and can work out kind of looking out in the future, because you have you have to think about not only when the building's first built, but as it's owned over time. And next slide, please, Mark. So there's also limits on the gross rents. So the gross rents, including utilities, can't exceed 30% of the maximum qualifying income for the unit. So you have to be aware of that too, that it limits the amount of revenue coming in. And since the maximum qualifying income is basically 6% of AMI, you have to be even more careful in the HUD homes that you're going to have enough money to cover expenses as they come along for the project. The projects can be either multifamily, like apartments or whatever, or single family, and they can also be either grouped together in a subdivision or scattered over numerous sites. So it's good that it's flexible that way. It can also be used, as I mentioned before, for new or rehab projects. So you have a lot of flexibility that way. It's more this income issue that's really the key issue to be thinking about, how you're going to handle that. And then the tenants can be given an opportunity to purchase their homes after the initial 15-year compliance period. So that, again, you have this compliance period, we have this big issue about income levels, but once you get beyond that, the tenants could actually be given an opportunity to buy the unit. And typically the amount of the purchase price is the amount of remaining debt, if any, at that point in time associated with the unit. So you can transfer, if your goal is to get, you know, cheaper housing to these lower income tenants that they can actually own over time, that can be a strategy too. But again, the big issue is just making sure that you're you don't have problems on the income levels as you go forward while they're in the compliance period. Mark, next slide, please. So that's the 9% program. That's the one that basically all the tribes that are in it tend to go for. And the reason again is that it's very competitive, it's very complex, but you get a lot of money and it can really drive forward a lot of homes. And you get money that can cover, you know, typically around 70% of the cost of the project. So it covers the majority. So what you have to do then is just fill in the gaps as opposed to cover most of the project with something else beyond the tax credits. I'm now going to talk about the 4% program, which is a lesser program, you know, because it only provides 4% tax credits, but it's essentially non-competitive and therefore can be valuable, especially if you have other sources of significant funding for the projects. One thing that really stands out to me is that if you receive, you're fortunate enough to receive a competitive IHBG grant, let's say for the full $7.5 million, you have a lot of money there to work with. And the leveraging of the 4% program might be a great way to structure the project to cover your leveraging requirements, so you don't have to tap into your NAHASDA money, your block grant money, and to perhaps build some more homes and have it all work out well. If you don't have a good source of other money, this won't work as well because doesn't deliver 70% of the project cost. It's more like 35, maybe 40% if you're lucky, of the project cost. So if you go to the next slide, Mark, we'll kind of delve into this and kind of talk about how this could work and whether would make sense for you guys to think about for your particular housing authorities. So again, there's the 9% program we talked about, which yields 90% over time of, you know, the money back of the investment back is a tax credit, but it's over time, so it's, you know, worth about 70%. And then there's these other program that's essentially non-competitive for 4% tax credits, so they're much more available. There's not the same kind of limitations on them. They are, however, those tax credits are subject to the same income requirements. You have the same issue of how do we make sure we're okay income level wise in these units, and the same rental rate limits. So we have to make sure that we have things covered enough in terms of cost, because we can't carry a lot of debt because we're not getting much in terms of rents. But those 4% credits provide about 35 to 40%. I think they provide a little bit more percentage wise, rather than being, like 7/9, like the, or 70% versus 9% credits, you think it might be like 30% versus 4% tax credits. The one thing is, though, that there's also depreciation benefits for these facilities to these buildings as well for the tax investors. So they tend to be a little bit better that way, but because of I was big bang kind of the 9% tax credits. Historically, tribes have always focused on the 9% program, even though the 4% program could also be available to them. Next slide, please, Mark. But it's important to think about, the 4% program at least is an option for yourselves for a few reasons. One, it's easier to get them, much easier to get them. So if you apply for a 4%, if you apply for a multifamily housing bonds allocation, you essentially automatically receive the 4% tax credits. And obviously a lot of folks that apply for the 9% credits don't get them because it's a very competitive process. So the 4% tax credits, because they're easier to get, can be valuable for a project if, again, you have other funds to leverage against them. So the question is, do you have other funds to leverage against them, basically, to basically fully pay for the project? Next slide, please, Mark. So there's a couple ways to think about this. You could think about your Title VI guarantee, secure the repayment of bonds up to 5 times the block grant needs portion. that can be valuable, but then you still have to pay back a loan on it. So it's probably questionable, except for maybe a small gap trying to fill that in, just like you might have a small gap that remains on the 9% project. So the real question is, do you have other significant sources of funds that are grants or things you don't have to pay back? And there probably are things to think about in this area. One is, the ICDBG could be valuable for a more moderate sized project. So if you get $2 million to come in, that could be really valuable. The Federal Home Loan Bank AHP program could also be valuable in that context, especially if you're one that if you're in a region that could provide a fair amount of funding. You also may want to think about state utility energy incentives I talked about before, especially for a rehab project. If you're in a state that has really good programs for lower income folks, like I know New York does, at least they did when we worked on the project there. So that can be really valuable. And there's actually a lot of states that are now, I know Wisconsin, for instance, looking at incentive, providing greater incentives now for lower income folks. So that could be really valuable to meet it. DOE funding we'll talk about tomorrow can also be really valuable, especially given the large amounts of funding now available under the DOE grants, where they can go up. The latest round that's going to come out later this year is up to $5 million of funding. So that's very significant as well. And then I think at least we've been made aware of this. A lot of our tribal clients and housing authority clients have had, have COVID relief funds that they've kind of been focused on. They're thinking about focusing on housing. So that could actually be a great thing to think about, that if you have X million dollars of funding for housing and you're thinking about using it for low income housing, which is what typically the COVID relief funds kind of direct you to if they're used in housing, that if you have money like that already, and you could actually expand how much housing you could build by getting the 4% tax credits involved. That's a way of leveraging that money, providing more value to the tribe and its members by taking, say, a few $1 million or whatever funding from COVID, or maybe perhaps more if you're from a larger tribe that's the tribe is thinking about using for housing. You could partner with the tax credit investor to leverage that funding and provide more homes. The same thing is true, as I mentioned before, especially for the competitive IHBG program, where you might get up to $7.5 million and then be able to combine it with these tax credits and then expand what you can build and actually cover your leveraging and protect your NASDA money that way. And this just notes that the latest round of COVID, the ARPA funds are really significant, and so some tribes are looking at how to spend that money still, or are thinking about it, or have allocated it to housing, and that could be this could be a good strategy that way. And next slide, please, Mark. So the bottom line is that if you can get the 9% tax credits, they're more valuable. It makes sense to pursue and to get. And then, but if you don't get the 9%, let's say you've been applying, it's been difficult in your state to get the 9%, but you also have other funds that are available, the ICDBG competitive, or there's ARPA funds, the tribe is focusing on housing, or you could pursue the other kinds of funding we've been talking about for housing and get it, or housing related stuff. Then it might make sense to use the 4% really as leverage for those other grants, the grant money you would have, to fill in the gap, to avoid taking out a loan, and to perhaps build more houses than you otherwise would, or rehab more houses than you otherwise would. So, and then also, given the large amounts available in these different buckets that are available, and again, I understand some tribes have more COVID money and have allocated to housing, some have not. Some tribes have some, it's hard to get the competitive IHBG, but if you get it, it's very valuable. But if you have that kind of funding available, and even if you get a 9% tax credit allocation, but if you wanted to build more homes, they'd have to be homes for lower income folks. But if you could make it work out that way, you would, do better, build more homes or rehab more homes by taking advantage of both the 9% and the 4%. And the next slide, please, Mark. Yeah, that's it. So with that, we've now just kind of looking back a second, we've went over, how to different mechanisms to finance basically rental housing, including more general grants, more specific grants for certain kinds of housing, loans that are available for this to help fill in the gaps, and then, you know, what is probably perhaps the biggest, in some ways the most important program, if it works for you income wise and complexity wise, is the low income housing tax credits, including both the 9% and the 4%. But now, so that's all rental housing financing. And now, assuming there's no questions you want to talk about right now, we'll turn over to financing home ownership.
Thanks, John. And I'll request control here. So this is a rather substantive topic. And as John said, we're still in the universe of our housing, but we're transitioning from rental housing and infrastructure potentially to more broader programs for financing home ownership. And some of these will sound familiar. Sometimes we've covered them, and there may be some underutilized sub-programs and functions that can apply to housing directly, to our home ownership housing. And we'll cover that today. But just one administrative thing for everyone. After this topic, we're likely going to break for lunch. So it may be earlier than expected. We're running a little ahead compared to normal. So we'll probably break and then return at 1 p.m. Central. So it may be a longer lunch hour, but I hope that's all right with everybody. That's usually a good thing, but we'll revisit that and restate that at the end of this subtopic today. So thanks. All right. So as it says here, these are the specific programs that I'm going to cover. And it is a lot, but a lot of them are topics we've touched on before and have a specific sub-program or underutilized program that particularly goes to financing home ownership projects. So the 5 programs that I'm going to cover are the HUD Indian Community Development Block Grant, the Federal Home Loan Bank Affordable Housing Program, the Treasury Department's Community Development Financial Institutions Program, and I'll try to use acronyms following this one, and then the American Dream Down Payment Program under the Home Act. And finally, 5th, BIA's Housing Improvement Program. So, find this. There. Many tribes may be familiar with the ICDBG, and some tribes file successful applications pretty regularly. Most often, though, these are for infrastructure, public use buildings, and housing rehab projects. It's pretty, I think, less well known that this program and their funds can be used for home ownership assistance to low and moderate income households. And that again is defined as individuals with income not exceeding 80% of AMI. We've worked with tribal clients that have been able to successfully access these funds for those types of uses, specifically with down payment assistance programs. And we've also worked with another tribe to obtain an $800,000 award for this purpose in the fiscal year 2021 round. So it can be a very successful application and tool if it can fit your project needs and your plan. The down payment, of course, is that type of program for assistance is to reduce the debt that the home buyer owes, and therefore that would reduce the home buyer's monthly mortgage payments. And we really think this is an underutilized feature of the ICDBG program, and that tribes generally are struggling to provide assistance to members who would like to own their own homes. You should really consider this aspect of this program. John's earlier presentation covered financing of rental housing with a fuller explanation of the criteria, specifically the point system, what matters for these applications. for the application process. He also touched on the amounts available and the application cycles. For the sake of everyone's sanity, we're not going to rehash those criteria in detail here, but we strongly recommend consulting the handbook for a quick refresher. So you have that handy, and that handbook was shared with your materials. And if you didn't have a link today to it, or for some reason you didn't receive it yesterday, the Indian Housing Handbook that Godfrey and Khan has prepared, we can insert that in the chat so you can look at it. Every time I use the arrows, it seems to go twice. There we go. All right. So that was the first program. The second program we're going to discuss is the Federal Home Loan Bank's Affordable Housing Program, the FHLB AHP. And this is the home ownership set aside program within that. This is primarily known as a subsidy for rental housing, again. So it's known for something else, but it does have a home ownership component for low and moderate income home buyers. And again, that means moderate income is household income not above 80% AMI. And usually these are limited, or they're especially valuable for members that are purchasing a home for the first time. There we go. So under this program, the home buyer enters into agreement with a bank that's a member of the regional FHLB, and the tribe or the TDHE can play an important role by providing a couple several services, including home buyer training, credit rehabilitation assistance, or technical assistance, and simply making the tribal member aware of this opportunity and putting the lender in touch with a member bank is coordination of technical assistance. Something to note is, to the extent that the loan is being made for home ownership on tribal trust land, then the same sort of legal infrastructure that we've discussed previously would be required to support any other mortgage program needs to be in place. So for example, the 184 program or the USDA home ownership programs, that would similarly be required here. So you have, like, for example, leasing ordinances, mortgage foreclosure ordinances, eviction ordinances, to ensure that these investments can be protected and enforced against with the lenders. So in order to initiate this program or to participate, the home buyer must have income below 80% AMI, like we discussed, but they also must complete a counseling program. And the counseling can be provided by a qualified third-party organization, but that could be the tribe or the TDHE. So you could determine that in your control. And another requirement is that they're a first-time home buyer. So each of the 11 regional federal home loan banks can design its own homeownership set-aside program in the way that it deems most effective within the framework of these regulations. And it's important to note that the maximum grant for these is $22,000, and permissible uses are down payments, closing costs, counseling, credit rehabbing of the actual premises. So it's fairly broad what this money can be used for. And $22,000 may not seem like a lot, but this would be very helpful for any individual that wants to seek some relief on the front end of any home buying process. And it can be partnered with additional programs to sort of make this as painless as possible for first home buyers. This double advance. Sorry, I'm struggling here. So I just wanted to clarify and emphasize a couple points here. The homeownership subsidy is called a subsidy, but it's really a grant. It's like some of the concepts we've talked about before. It's a grant that can be revoked in the event that the borrower sells the home within 5 years. So in that case, the home is sold, and there's a payback provision that's contemplated for the up to $22,000. Especially, well, and again, that's only if the home is sold at a profit, which hopefully that would be the case. But so it still functions as a grant. Most people live in new homes for over 5 years, so this rarely occurs. But if it does, they have a provision in there to prevent unjust enrichment just flipping. This is not a program for flipping real estate. So we covered 2 programs. And the third that we're going to cover is the Treasury Department's Community Development Financial Institutions Fund, the CDFI, and the related Native American CDFI Assistance or NACA program. And the purpose of the CDI fund generally, and this is one of general applicability, is to promote economic revitalization and community development in underserved areas. And the Treasury Department funds these nonprofit entities known as CDFIs, and the CDFI in turn provides assistance to underserved populations and low-income targeted populations. So within that general overall program, CDFI program, as I mentioned, there's a specific Native American CDFI assistance program that is designed to assist CDFIs focusing at least half of their activities on Indian country. So, and by now there are quite a number of CDFIs that target their activities towards Indian country. A CDFI must be independent of tribal government and include members of its target population on its board of directors. HUD can certify CDFI as the originator of a Section 184 guaranteed loan program, which means that the CDFI can earn an origination fee for doing the paperwork for a lender that does those loans. A CDFI can originate loans under the Rural Development Section 502 program that we talked about. And there are a number of Native American CDFIs now that are devoted to serving the needs of tribal members wishing to become homeowners. So these act as agencies that play a really important role because the TDHEs have historically not had the resources or the staff to serve would-be first-time home buyers in the community. So this is something to look into almost no matter what for if that's a need in your community. All right, so we covered 3 programs. The fourth, we'll touch on briefly is the American Dream Down Payment Initiative. And this is part of the Home Investment Partnership Act. So the participating jurisdictions who receive those federal funds through the home program are required to allocate 15% of their funds to community development housing organizations. And the American Dream Down Payment Initiative can be funded through those agencies to provide down payment assistance to tribal members. So again, this is a general applicability program. It's not particularly geared toward Indian country, and in our experience has been rarely used, and so underused, but it's yet another potential funding source for tribal member homebuyers. And tribes wishing to learn more about this program should contact their state housing finance agencies and for a list of community development finance organizations in your area. Okay. And finally, we have the Bureau of Indian Affairs Housing Improvement Program, HIP. Under this program, the Bureau provides funds to repair, renovate, replace, or provide housing for the neediest Indian families who own their homes. And this is a value up to $35,000. It's often administered in conjunction with IHS. And homes financed through tribally designated housing authorities under HUD funding, either the previous 1937 Housing Act or the Indian Housing Block Grant since 1996 under the NHASDA. They're not eligible under HIP. So this sort of has to be without those additional housing payments that have been made, that would sort of make a clear determination whether you're eligible or the specific homeowners would be eligible. And let's see. It's a point of emphasis here that I didn't cover. I'll go to the next slide here. It's important to note that eligible beneficiaries of this program must be tribal members living in a tribal service area who own their own homes in need of replacement or repair. So this is not a program for construction of new homes necessarily. It's to maintain and improve upon existing home and housing owned by tribal members. And we have lists some criteria here in the slide for eligibility. And again, these eligibility criteria are found in the handbook. So you need a housing annual income that doesn't exceed 125% of poverty income guidelines. The present housing is substandard, deficient some way. He or she has not received assistance after a specific date for repairs, renovation, replacement housing, or down payment assistance. The present home was not acquired through a previous housing initiative program, two of those, and you're without any alternative housing assistance, and the ownership requirements are met. So again, this is pretty specific, the type of projects, the type of homes that this is targeting, but it is to try to address some that may have fallen through the cracks and are not, that are current needs of your community. So talking about the process for this, how the program is implemented. So a tribal member applies to the BIA, which then ranks the project. Then when funding is available, the tribal member obtains a grant for the necessary repairs for new housing. Funding of the HIP program has historically been insufficient to significantly address shortages or overcrowding or any other chronic housing conditions in Indian country. So it's unfortunate that the funding has been low, and hopefully with more participation, the need will be addressed and then it'll be sufficiently, the coffers will be more will be allocated to this valuable program. So I did want to summarize before we close out and take a longer lunch break. There's some important topics. The ICD-BG program is normally not thought of as a home ownership program and should be. It should be considered as a source of funds for down payment assistance, which can be very valuable. The AHP program is underused and has great potential to assist tribal home buyers, and tribes should identify local member banks and connect with their prospective home buyers to utilize this program. The CDFI program I spoke about is also valuable for plugging that gap that TDHEs have traditionally had, these gaps in funding. The difficulty there being that they have in serving tribal members who want to be first-time home buyers. So hopefully that program can help out. CDFIs are explicitly designed to lend to low-income tribal members, and some of the CDFIs are devoted to small business owners too. But again, some others CDFIs focus on mortgage lending, and you should seek those out. TDHEs should identify local CDFIs, and if there are none in your area, consider forming one. And we can provide additional information about how to best do that if that's something you're interested in. For each of one of these programs, tribes should consider providing credit rehabilitation and homebuyer training services to help members qualify. So increase your chances of success and to get your tribal members that are otherwise eligible, just get them aware of these requirements and help coach them along the way. So thanks for your time this morning. We're going to break for a considerably longer break here at Bobby, and pause now, and we'll return here with it. And
again, we're talking about home ownership here now, and we've gone through the grants related to it. Now we're going into the loans related to it, basically. So I'll be handling this, and then we'll move on to energy after that. We're a little ahead of where we thought we might be based on the last couple of these TAs we've had this way, which is good in some ways. We're being more efficient, I guess. But we'll see where we're at the end of the day, and then what we finish up to. We'll finish it up tomorrow. We might be done a little bit early, is all I'm saying, I guess. But we'll also have time for any follow-up questions, that kind of stuff too. So we'll be available for the full time, except folks want to talk, but we might be finished early is the bottom line. So with that, I'll start talking about the loan programs that are probably most relevant to home ownership. Actually, Mark, can you go to the next slide, please? Yeah, so there's basically 3 programs I want to talk about, make sure everybody's aware of. One is the HUD Section 184 loan guarantee program, which I think it might have been discussed a little bit before. The USDA Section 502 rural housing direct loans, and the 502 guaranteed loan program. And then, so basically, the guarantee programs are one where you have a private lender coming in and the government's guaranteeing the loan. The ones that are direct from the federal government. It's the basic idea that with those programs. And then there's also what's called the Section 502/523 mutual help program. That's kind of like a combination program. It's a combination of lending for the homes, as well as essentially like a Habitat for Humanity type program where the homeowners actually put in sweat equity into their homes, which reduces the price of the homes and therefore makes them more affordable. So with that, Mark, if you just go to the next slide, that'd be great. So HUD Section 184 loan program is probably the most prevalent home ownership loan program in any country by far. It's called 184, Section 184, because it's Section 184 of the Housing and Community Development Act of 1992 is what allows for this program, which is it's a loan guarantee program again. So it's 100% guarantee of loans made to qualifying Indians, by banks, paid by private banks, basically. And the guaranteed loan can be used to purchase or rehabilitate an existing house, to purchase manufacturing housing, to purchase and rehabilitate an existing house, or to construct new housing. So basically, it's a wide range of options in terms of what you'd use the money for, what the member would use the money for, if he or she is wanting a house and to own the house. It's only available for certain kinds of houses. It's for single family and like multifamily, up to 1 to 4 units that can be located on either trust land, tribal trust land, allotted kind of member trust land essentially, or fee simple land that's in an Indian area. So it can be on reservation or off. The original idea of the program was mostly to deal with the situation where it's on trust land, whether tribal or allotted trust land. The banks were hesitant to lend money because of the inability to essentially get a true mortgage on the land, on the property, because of the fact that there can't be any, as we talked about before, there can't be any transfer of ownership, any assignment of ownership interest without in the land. You can't actually have the land be taken over by the bank, basically, without federal government approval, which is very difficult to obtain. It's very difficult to obtain because of the policy of making sure the trust land is basically protected. So, this is a program to provide the guarantee to the banks so they can feel comfortable in lending money to the tribal members, or as you'll see later on, also the tribe. And basically, that's the next point. The borrower can be an individual tribal member, so it could borrow the money so it can own the home itself. It could also be the tribe or TDHE, and we'll talk about a little bit later on, that allows for the creation of kind of like a rent to own program by the tribe or TDHE. And I guess and one reason why this program is popular, and one reason why it's very important to be aware of, is that it provides guarantees that are not reserved just to the HUD kind of income level, not just to moderate and low income home buyers. It can also be used for home buyers that have more money and therefore can more easily afford a home normally, but for the difficulty getting mortgages in any country. So it's a very important program that way, especially if you're trying to think through how do we is that you have the low income housing tax credits, which are very valuable, provide a great option for bringing in housing for truly low income folks, but it doesn't address the moderate income folks, necessarily moderate or low income folks, which could also be addressed by the HUD grants and some other grants we talked about, as well as some of the programs we talked about. But then it also, those two don't really address the idea of the kind of more just moderate income folks, moderate and higher income folks that are on the reservation that would like to be on the reservation, would like to own their own home potentially, but otherwise can't take advantage of various programs to do so. This one provides a program to do that because it's available to higher income folks. Mark, if you go ahead, that'd be great. So an advantage of these loans, in addition to just kind of addressing the issue of how do you get a mortgage basically in any country, is the fact the down payment can be low. So the down payment for a small loan, this would be more for a rehab, probably an existing house, can be as low as 1.25% on loans under $50,000. If the amount exceeds that, then the down payment's still very low. It's 2.25%. And the money can come in from a variety of sources. So a lot of times when banks are providing a mortgage on a home, they require that the funds be the funds of the actual homeowner. So they can't, they can't typically be paid by others, at least in some cases. Here they are fairly broad. The funds can come in from private funds or from a gift from the tribe or TDHE. So it's not like the homeowner himself or herself has to get the 1.25 or 2.25% together. That could be in the form of potentially a gift from the tribe, if the tribe was, having a program basically to say, if you're going to do this, we'll provide money for the down payment, might be the way you do it. Also, if the borrower's income is less than 80% AMI, and therefore they be a HUD eligible, basically, resident, under the low and moderate income standard, then the HASDA funds can be used to cover the down payment. So that's another way for you to potentially help to move this program along, help people get involved in it, is if they don't have savings, but they have at least enough income to be able to support the mortgage on the home. This could work well for that too. There is, the HUD's providing a guarantee, and there's processing and stuff they have to do. So they do charge a fee for the guarantee. It's a 1.5% fee on the, value of the home or the price of the home. And they also have a relatively small annual loan guarantee premium of 0.15%. And then on top of that, if the home, the loan, as long as the loan to value ratio exceeds 78%, there's an annual insurance premium equal to 0.25% of the loan balance. So there are certain fees on top of the rate that the bank would charge for the home. On the other hand, this program, basically allows for a low or no down payment approach, essentially, and allows, it gives banks comfort to lend in any country, which is obviously important. And then the lender, because HUD is guaranteeing the loan, they want to make sure the lender's done a really thorough job to make sure that the borrower, especially if it's an individual member, has the ability to repay the loan. So there's not going to be a default, because if there's a default, then the HUD, as the guarantor, has to pay back the bank, basically. So so they require the lender do a thorough evaluation of the ability of the borrower to repay the loan, and to take into account, therefore, the income history of the borrower, the stability of that income history, the credit history of the borrower, and kind of factors like that. So they're basically making sure the bank is not going to kind of slough off because they know the federal government's going to back up the loan. They wanted them to treat it as strongly, or probably even more strongly than, evaluate as strongly or more critically or whatever than they would a loan to an individual where it's not guaranteed, so that hopefully the guarantee never needs to be exercised. And then to do that, they basically have a debt to income ratio that can't be exceeded. In general, that number is 41%, but HUD can make exceptions, in certain appropriate circumstances. But basically, what they're looking for is making sure that they have a good credit history, a good income history, it's stable income, and then that their income to debt ratio or debt to income ratio is not too high, because obviously the higher it gets, the more risk there is that they won't be able to repay this loan, the tenant, the homeowner. Next slide, please, Mark. And so there's so I'm sorry, there's also another kind of key element to this program. And the other key element is that the tribe needs to enact a legal infrastructure, put in place ordinances basically to support mortgage lending on the trust lands. And the biggest issue here is really the ability to foreclose. They need to make sure there's a solid leasing law in place, so that there's a clear lease from the tribe to the tribal member. But there also needs to be, within that or outside of that, a mortgage foreclosure ordinance that allows for foreclosure on the loan if the homeowner is not making payments. Because if there's no foreclosure, there's no real, a way to address the issue of non-payment. But what they do allow for, though, is a tribal right of first refusal if in the event of default, and that's a conversion in these, so that the tribe can make sure that the property really never leaves the hands of tribal members. So one tribal member may have problems, but as long as the tribe can take over the property again and then have the structure provided to another tribal member, the reservation, kind of essentially remains intact in terms of who the residents are. So that's a key provision. It's an important provision to probably have in every, legal structure will be put in place to support these loans. And it allows for the needed action, which is if a member's not paying the amount they owe on the loan, the property can be taken back just like it would outside of Indian country, but the tribe can make sure that the home ownership remains within the membership, and the tribe, kind of from a community perspective, remains intact. They also need to have an ordinance that includes eviction procedures, so that the folks can be evicted, unfortunately, if they're not making their payments. All three of these are available. HUD has like form ordinances that your tribe, if it doesn't have these ordinances, could adopt. They also, though, may want to especially look at the ordinances and make sure they make sense for their particular reservation, and probably tweak them or perhaps create their own. But making sure that it matches what the tribe's needs are too is really important. So you're not just having laws kind of thrust upon the reservation, but you do need to have these three kind of key pieces of legislation if you're going to want to have the 184 loans occur on your reservation. And again, the primary purpose for this would be if you have folks that have some income that's enough to support whatever kind of home they're going to buy, and they have a strong interest in owning a home. This allows you to provide homes, help provide homes for them that they can own. It also helps to address issues where you have folks that are not necessarily making a ton of money, but they're making enough money, they're above the low to moderate income standards, so they can then participate in tribal housing and in fact own their own tribal housing. So it's an important program, especially if your tribe has that kind of population that it's trying to serve and trying to include in its community among its membership. And because it's been a popular program that's been around. Next slide, please. So if you want more information about this, actually, Bill, do you mind just putting this link into the chat room, if you don't mind? It'd be great to help us out. Great, thank you. So if you want more information about it, this is the link to go to. And then you can also contact the Office of Loan Guarantee in the Office of Native American Programs for HUD, and there's the email for that. So it is a very valuable program, especially if you're getting information from the membership they'd like to own their own homes. It's especially the folks that are in that category tend to be folks, a fair amount of them, that are above the HUD income guidelines. Then this could be a really helpful program for you. And the next slide, please. So that's the key HUD program. I'll now talk about the key USDA rural housing programs. And the first one I'll talk about is the Section 502 direct loans. And basically under this program, the Rural Housing Service provides loans at below market rates to home buyers who have incomes below 80% AMI. So we're going back again towards, the folks that are typically served by housing authorities in their HUD homes because they're, that 80% or below category. To have this kind of program occur on the reservation, you still need to set up the same basic infrastructure we just talked about for the HUD Section 184 program. So you need to have a leasing ordinance, you need to have a mortgage ordinance, and that includes, foreclosures on mortgages, and you need to have eviction laws to support the program. So, the same kind of thing, the same issues come up because, in this case, USDA is a direct lender, but they want to make sure that this can be treated as relatively close as it can to a normal, or maybe that's normal, the wrong word, but a typical off-reservation mortgage situation where, the homeowner enters into a mortgage and they can be, foreclosed upon and evicted essentially if they don't make the payments. One key term of this program is really that it has two features, basically is the way of looking, but I think that can significantly lower the monthly payments, which is obviously great to help out low to moderate income families, be able to afford a home, and also to avoid foreclosure situations because you're not charging too much in terms of principal and interest to make the home payment unaffordable, especially if there's some, kind of glitches that occur in the person's income or issues come up where they got to spend money on other things. So one key factor that they have is that the loan terms are longer than typical. They can go to 33 years, which is somewhat longer than a 30-year mortgage, obviously. And with homes that are owned by folks that are less than 60% of AMI, the lease terms can be, the loan terms can be extended further. And so when that happens, you don't have to pay as much principal every year, which then helps to lower the monthly payment. The second thing is that there are subsidies based on the homeowner's income. So the lower the income, the greater the subsidies, and the lower the income, the closer you get to it, therefore a 1% interest rate. So the rates are potentially significantly lower than market rates, especially now with the rising interest rates going on. So it can make the homeownership substantially more affordable that way too. So you have a relatively long period of time to pay back, even though you're, in this case, in Indian country where there would typically not be a mortgage. And then secondly, you have a lower rate of interest that, and it's lower because it's focused, it's focused on folks that don't have as much money. So both tend to make the homes more affordable and the program more accessible. And the monthly payment, because it has these subsidies, can go up as the income for the homeowner goes up. So it's not necessarily totally fixed, but the rate establishes a cap. There's a cap on the rate so that it can't go too high. So it's meant to tie into the homeowner's income, the rate, and to be somewhat protective to not go too high. And the good thing is that the loans cover 100% of the cost of the home, as well as the appraisal, title, and other closing costs. So it can cover, so you don't have to bring money to close. Basically, you don't have to bring down payment money. You don't have to bring closing cost money to close. So that obviously makes the home more affordable. And it's, since it makes sense that that's an element of the program because it's focused on these lower income families. So you're not going to have that kind of money to bring to the table at that time. The funds can also be used to repair an existing home or relocate that home. It can also be used to repair the site for the home and to provide water and sewer facilities. So it actually helps also with the infrastructure for the home. if you're building a new home or working on a home for members, home sites for members, it can also pay for that. This stuff generally related to that. So the program is it's an important one. It's not as used nearly as much as the 184 program in any country, but it's really valuable for all these things we kind of talked about on this slide. Next slide, please. Because the loan is subsidized, and I think the intent of the program is not to provide, mortgages to those who can get conventional mortgages, and because this program is not just targeted in any country, it's a general rural housing program. They do require that there's evidence that the homeowner has been basically, or home buyer has been turned away from conventional sources of financing on reasonable terms, and that they also have to show they can afford to repay the loan. So it's kind of an in-between situation. It's trying to capture folks that under this program can afford the home and can pay the mortgage off, but under conventional loans could not. So they're trying to basically target the market they're going after, but the USDA is basically going after for these loans, so that it's so they're targeted to go after folks that are not the folks that would otherwise get a mortgage, or that really shouldn't be in the program, but the kind of that middle set of folks that can afford to buy a home if they can participate in a program like this, and can afford to, more importantly, are projected to be able to afford to continue to make the payments and not go into default. And then so they have a kind of a formula they use to figure out whether a person can afford to repay the loan or not. And it's really looking at if the principal, interest, taxes, and insurance, so all those things, if you own your own home, you probably notice that those are things that oftentimes are paid for under the mortgage, where especially your taxes and insurance are escrowed. But they want to make sure that total amount is not more than 29% of the total income of the person, so that basically they should be able to pay that, to be able to meet that obligation regularly and not have problems. And then they also look at what the total monthly debt will be, and that it does not exceed 41% of the total monthly income. So you're looking at debt generally, as well as the specific debt and debt and related obligations for the home. For lower income home borrowers, the ones that are probably 60% or below, the percentages are somewhat adjusted to be a little higher percentage of income towards monthly income towards the monthly debt on the home. I think because of the recognition that it's difficult for them to get to the 29%, but they don't want to go too much above that. And then they're the same though, 41%, debt amount based on monthly income for all debt. That's the requirement. And then they don't want you in this program too long. So if there's terms that require refinancing the home if the buyer is able over time to do that. And then there's a retention agreement. They also don't want a buyer to just buy a home for speculation, to move on and get the benefits of this low interest loan and then be able to sell for, kind of flip it for a profit. So when title is transferred to a third party, there's a requirement that the home buyer either repay the interest assistance, so the subsidy on the interest, or 50% of the appreciation on the home, whichever is lesser. So it's not really a program that probably makes as much sense if the buyer only wants to own for a little while and then sell off, even if they don't want to, even they're not doing it to flip necessarily the home, but just want to own it for a few years and then move out, because they're going to have to repay a lot of the money. But if someone wants a home, if someone wants to move back to the reservation, or lives on the reservation, wants to have a home on the reservation, and then wants to live there, for the foreseeable future, this loan program can be very good because of the lower interest rate, primarily because it, low interest rate and no down payment are really the two keys here. Next slide, please. So under this program, you need to have the same kind of idea of tribal court enforcement procedures, including foreclosure in the event of default. So again, they want to make sure this is run like a more traditional or conventional mortgage from that perspective. despite the fact that the property may be on trust lands, which, cannot be taken basically. And they use the same kind of model lease, mortgage foreclosure, and eviction ordinances. They have this one-stop mortgage initiative, which has these various agencies that agree on what the documents can look like. So all that same documentation can meet the requirements for this loan. And then in this case, the individual, rather than the tribe or TDHE, so it's a little different. That it's the individual that applies for the loan. It's not like the TDHE or home or tribe would do it and then do that rental program, rent to own we talked about before for 194. But the TAHE can be involved. The issue here is really that educating the members about the option here and getting them kind of packaged up for the loan is kind of the key issue. So they're not having to go on their own and just try to figure this program out. So the TDHE can facilitate the process by providing information and counseling to members so they can understand how the program works, and by acting as what they call a packager, putting together the materials for the home for the loan package, assisting in hiring a general contractor to build a home and things like that, and helping prepare the applications for the loan. So, and then 502 has money that is available to the TDHE if it acts, which comes from the loan proceeds once it's paid out, if it acts as a packager. So, the TDHE can have an important role under this program in terms of making members aware of it, probably aware of both its, truly aware of it, both its, its benefits and its requirements, which are, they has to make sure they can be comfortable with, and then helping them to put their application together and work with their contractor, they're building a home. It could be, for example, it could be, it may be that the tribe or the housing authority is working with a contractor you think is good, and they could, in addition to the homes they're building for the tribal housing authority, they build these additional homes that could be owned by members. You could help them with that kind of stuff, and then be paid a fee by HUD for helping put this all together. Next slide, please. And then, I'm sorry, then 502, I'm sorry, it can also be used as a part of a rent to own program. In that case, this is what I'm sorry, mix up a little bit. The TDHE develops and owns the homes initially using other financing programs, and then over a period of, let's say, 1 to 2 years, the members that could not otherwise qualify for 502 loans can build up their credit history and through a payroll deduction type program and credit counseling, and then be able to purchase the loans and purchase the homes, I'm sorry, and get the 502 loans. So the tribe or TDHE can create a program that way, where it just initially buys builds and or buys the homes, and using other financing programs, and then works to make the homes available to members as they build up their credit basically and can qualify for the 502 mortgage loans. Next slide, please. So in addition to the direct program, so that was what I went through before, just make sure it's clear, is it was a direct program. So that's a loan program where where HUD provides the loan directly to the member. The second program that they have, another program, is the 502 guaranteed loan program. And here, rural development, would guarantee a 30-year fixed rate mortgage that would be made by a third party, private, just normal commercial lender to low and moderate income home buyers. And this could be used either for new construction or repairs of existing homes, just like the other program. And it also has, because the loan is guaranteed, you have up to 100% loan to value financing. So basically allows tribal members that don't have, the funds for a down payment, which is probably, more common among low to moderate income folks. This allows for those low and moderate income folks to actually buy a home without having to, bring a lot of money to the table, which is obviously a big barrier to buying homes. So, and similar, you can use the money to purchase and prepare the sites, as well as provide water and sewage facilities. So again, it can be used in a way that helps quite a bit with the infrastructure, as well as the home itself. And then the USDA also provides payment subsidies to eligible buyers, which effectively reduces the rate of interest on the guaranteed loans and lower the monthly debt payment. So it's basically in addition to the guarantee, there's also subsidies that go, so you can have, which allows for both 100% loan to value financing, which means there's no down payment, and then secondly, lower rates. This is not available for multifamily housing, so just for single family homes. It's available only to individuals and not to tribes or TDHE. So it's really just a direct, it's a loan guarantee program that's directly focused on tribal members as opposed to the tribe or the TDHE. One more thing you might say, well, why would you do the loan guarantee when there's also the direct payment? The direct payment amounts can run out throughout the year, a given year, and at times there's loan guarantee that are available when there's not the direct loan. So it's another alternative to doing essentially the same thing, but where the federal government, instead of acting as the direct lender, if it's run out of the funds it can lend, it may still have funds to make the loan guarantees, and therefore this is another program to be aware of because of that. Next slide, please. So the last program, so we talked about, three basic programs, or two basic programs so far, or I guess maybe three. The 184 loan guarantee program, the direct, which is the HUD program, which helps, especially where you have some higher income folks on the reservation that would like to own homes, that they can participate in that, as well as lower income folks. All of them obviously have to be able to afford the payments to be able to do it, but it's a way of building up home ownership on the reservation. The second one, the 502 program, which is more focused on lower income folks, and where there's both a direct program and a loan guarantee program, but there's rate subsidies and the ability to get basically the down payment issue taken care of with the 100% payment or home and 100% loan. The final program is the 502-523 mutual self-help housing program. As I mentioned at the beginning of this subsection of the program, this program is kind of like a Habitat for Humanity program, if you've ever been involved in their projects, in the sense that the homeowner becomes involved in the actual building of the home, and that helps to lower the costs of the home and to make the program work, basically because of that. So and then the 523 also provides a grant to a sponsor of a group of homeowners that want to build their own homes basically together, and to finance those homes. And that grant can go to, like, a sponsor can be a tribe or a TDHE. So they can, the TDHE, for example, could receive money to help work with, the participating families, which might be about 5 to 10 typically, to help them develop and build their homes basically under this program. And then the TDHE would then receive funding to do that. So it's another way for the TDHE to become involved and help the members reach their goals for home ownership. And this, grant can cover the housing authority's costs for a construction supervisor and a caseworker, for office expenses related to the project, for bookkeeping, purchasing tools, insurance fees, for the training of grantee personnel, for the training of TDHE personnel to be involved, including the board members of the TDHE, and then any consulting, or not any consulting, but consulting, accounting, and legal fees required to administer the grant. So, basically it allows for the TDHE to have funding to become involved with the families to help them to develop and build their homes. And the TDHE's construction supervisor, would then teach the participants, the folks that will become the homeowners, to build their own in each other's homes. And so the homeowners actually work together to build all the homes together. And then they get, this is kind of the Habitat for Humanity connection or parallel. The idea of building trade skills among the homeowners and then getting sweat equity in the home because of the work they do that reduces the cost of the home and therefore reduces the amount they have to borrow. So it's really a program to also help, kind of help homeowners develop skills both for maintaining their own house and potentially for being, getting involved in the building trades, and then reducing the price of the home because the homeowners do, most of the work on the homes, and then they can pay less on the mortgage. So next slide, please. And then, so the homeowners that participate in this program are also eligible for a potential down payment assistance under Section 502, which then, helps reduce the monthly payment that they have, and also, what basically does that helps them to build up equity in their home faster. And then the homeowner or buyer also would then borrow money at a subsidized rate of interest, under the 502 program, and take legal title to the home immediately, subject to the mortgage. So basically what it does, this program, by having a lot of the labor covered by the homeowner, as well as the ability to get a down payment assistance, potentially, you squeeze down the cost of the home, and the home buyer is able to buy the home more cheaply, and under a cheaper mortgage, therefore, and then have more equity in the home kind of right away. Next slide, please. And the participants have to have acceptable credit to be in the program because they, just like the other programs we've been talking about, but basically the standards are not quite as stringent, at least as those of a traditional commercial lender. The big thing the participating families are expected to do is perform 65% of the labor associated with the construction of the home. And my understanding of the way this works is that, they'll work on the families will work together on it. If there's 5 to 10 families, they'll all work on all the homes together. But overall, as a percentage of the labor that would go in any one home, a family has to provide 65% of basically the labor hours for the construction of the home, which again is kind of like a Habitat for Humanity kind of concept of the homeowner having sweat equity in the home, and which then again reduces the cost of the home and is good for everybody, but it requires a substantial commitment by the homeowner to do that as well. And at least if you're interested in doing this and you put a group of participating families to be part of the program, at least 40% have to have income at or below 50% AMI. So this is really targeted at a fair amount of low income folks. You have to be able to, that you're serving. So this is again the program. It's not like 184, which goes above the HUD standards. This is really more going kind of to the lower income levels and really helping folks that normally could not have a house get a house that they would own. And then I think that's it. But next slide, please. It's not it, sorry. And then it's really the same as before, basically. That's why I forgot about it. The same requirements for, if you're on trust land, again, the tribe has to have enforcement procedures, including foreclosure. So the same kind of idea of a model lease, foreclosure, and the eviction ordinances need to be put in place. It's the same thing. It's really in all these programs for homeownership where you're on trust land, they need to make sure that something relatively similar to the normal foreclosure action that would occur if you don't pay your mortgage would be in place. And I think that's finally it. Thank you. Mark, can you go to the next slide? It's actually not, sorry, I guess and then one more thing, I guess, that we have here is that, rather than applying for assistance directly, the housing authority, so you can act as the folks that, act as a facilitator for this program, or you can also partner with an off-reservation applicant to administer the grant and provide the services. While maybe the TDHE focuses more on identifying which folks would be good homeowners and assisting those professional homeowners. So you don't have to necessarily take on the role of being the construction supervisor and everything like that. You could basically subcontract that out by having a partner apply to be the one that provides those services as well. And there's a notice of funding availability, a NOFA, basically for this program, published annually, usually in spring. And there's the website for additional information about the program. The last thing to note is that the funding for this particular program, for the self-help program, is limited. There's only so many folks they'll take into the program, so it's the applications are scored competitively. So I think if you had strong interest in this, you'd want to really, kind of think it through, think through how you can best, just like all the other grants, you can best score to make it work. But that's the program basically. Next slide. Okay, great. So finally, I felt like it was right about the last slide, kind of. So let's see, we're at one. Yeah, so we're about 45 minutes past the hour. We'll probably do is we'll go on for another half an hour or so, and then, or let's say we'll get started and then we'll take a break. Maybe what we'll do is we'll do the introductory stuff for energy and then take a break and come back and do a little bit more. And then if it's okay with everybody, we'll do the same thing tomorrow. We'll kind of summarize what we think are the key points out of today's session tomorrow morning, and then continue on and finish up the energy stuff, and then also address any questions about it that you guys have, or just make sure everybody's on the same page on what you got out of the program. So, but now, what probably makes sense is to talk about, financing. Our next section is financing renewable energy and energy efficiency and electrification. So basically, what we want to talk about now, electrification, we have it in here because there's become a greater focus by Department of Energy and some other granting agencies to help electrify buildings that are not electrified. So if you have any situations like that, if you have some more remote buildings on your reservation that need electrification, we'll be talking about that. And then but in general, we'll be focusing on financing if you want renewable energy for your housing or for your reservation in general. The most typical approach to that is through solar, just because it can work in almost every context, but it can be these funds can oftentimes be used for other technologies too. And so if you have any thoughts about that or questions, please bring it up along the way. We can kind of just talk about the applicability to other technologies. Another kind of twist on the technology that's being pursued a lot now, especially where there's reliability issues or where there's special funds for these kinds of projects, or special programs to participate in, is to have not just solar but also have battery storage incorporated with, and you can create what's called a microgrid, which can be very helpful if either there's reliability problems in your area, or what we'll talk about later on, these net metering programs and other programs that a lot of areas have are not available, and you might otherwise be giving away your energy for free if the production of the energy doesn't match up to the usage. So we'll talk about that as well. And then we'll talk about money for energy efficiency as well, which is obviously an important issue for both new construction of homes and related buildings, but also especially for rehabbing homes and buildings to make sure that they are in good shape. And a key portion of that oftentimes is putting in new windows, new doors, new insulation, new appliances, and new HVAC systems, all of which can also reduce the operating costs of the homes, which is great. And especially if you can find ways to fund them, and that's what we're going to talk about today. Tomorrow is how to fund those things. So, and one thing to note kind of initially is there's just a lot more money available for this now than there ever has been before, both in terms of grants and tax credits. So we'll go through all that stuff and how, in some cases, you might be able to, put in place a lot of free improvements, fully paid for improvements that don't require using any of your NHASNA money for that. So with that, I'm going to turn it over to Mark, who's going to talk about some of the basics of renewable energy and electrification, so we can kind of all be on the same playing field as we start to talk about the programs to finance all this stuff.
Yeah, thanks. All right, so we're similar to broadband. I'm just going to kind of go over some basic information so everybody has that background, and we're all kind of playing on the same field here. So traditionally, the key sources of energy for housing have been electricity, natural gas when where it's available. But other than that, then it's going to be heating oil, propane, or wood, all burning for heating. There's been a pretty strong movement recently to switch from the various non-electric sources of energy like propane, heating oil, gas, to the use of electricity for heating, hot water, and transportation. This term beneficial electrification has really become popular here, and it's referring to the ability to switch to electricity from one of the other sources that is both beneficial to the end user and to the environment. This usually depends on the price of electricity being lower than the price of the other fuels, and assuming that the electricity is cleaner, provided that it comes from renewable resources. So an example of beneficial electrification, I think one that's probably the most common, is the use of heat pumps in heating and cooling and HVAC systems. So electric heat pumps are generally more efficient than a fossil fuel powered HVAC technology, and can now be mostly used in hot and cold climates. Generally, heat pumps are between 2 to 4 times more efficient than an Energy Star gas furnace on an annual basis, and are slightly more efficient in places with mild winters, such as Texas, California, Arizona. But that's changing. There's quite a bit of development here where heat pumps are becoming more efficient even in colder climates. So like where the three of us are in Wisconsin, where it's 5 degrees out, their heat pumps are becoming more efficient and actually aren't having to be paired with gas furnaces as much as the technology advances. So with this enhanced efficiency, heat pumps can save consumers money and reduce those negative environmental effects of heating and cooling compared to a fossil fuel fired furnace or their fossil fuel counterparts. Additionally, the cooling side of heat pumps, so heat pumps run as heat and air conditioning. The cooling side of the heat pump is often substantially more efficient than a normal air conditioner. And then when coupled with smart thermostats, heat pumps can be turned off and on to enable better grid management, and then used to preheat and pre-cool spaces during times of lower demand, can reduce that energy usage during peak hours or utility peak hours, which can help keep energy costs low if the house is on a time of use rate, which provide cheaper energy during certain time periods. So that's, you get charged one rate for energy used during the day when essentially everybody's on the grid using energy, and then different prices if you're using off peak, usually nights, weekends, holidays, that kind of thing. So some other examples of residential beneficial electrification include probably things you've seen before: induction stoves, electric clothes dryers, electric lawnmowers, leaf blowers, as well as many people are probably aware, the significant movement and development towards electrification of the transportation sector, especially with personal electric vehicles. EVs provide a pretty large opportunity for reducing environmental impacts in the transportation sector and significantly can reduce operating costs of a vehicle. It's also important to note, though, that not all electrification is beneficial. Just electrifying something isn't going to automatically mean that it's benefiting the customer or the environment. In some cases, it can actually reduce efficiency, it can increase emissions, or it can raise costs. To focus on the good opportunities, the Regulatory Assistance Project, which is kind of a policy project think tank that helps advise a lot of public utility commissions throughout the country, defines the term beneficial electrification to be that electrification in which one or more of the following conditions here are met without adversely affecting the others. So it has to either save consumers money, enable better grid management, and reduce negative environmental impacts. One of those three without negatively impacting the other. Excuse me. Right, and again, the importance of electrification meeting these requirements to be actually termed beneficial. And with respect to tribal housing, it's especially important to focus on saving consumers money over the long run, since that's what's going to make the tribal housing more affordable. So some other renewable basics here. Wind and especially solar are probably the two most used renewable energy technologies that you'll see, especially for housing. And it's kind of important to be aware of their limitations as what are called intermittent resources. So electricity for housing, electricity for any kind of human consumption is used during the day and at night and in the evening. But as everyone knows, solar only produces energy during the daylight. And wind facilities only produce energy when and if the wind is blowing. So due to those limitations, it's important to make sure that an energy resource benefits tribal housing even when energy usage and energy production aren't necessarily going to align. I would flag, and John just mentioned a few minutes ago, with the recent changes in the Inflation Reduction Act and just the availability of materials and technologies, batteries can become a more viable solution when paired with wind and solar, and they can kind of help smooth out that intermittency as it relates to wind and solar. So on that note, on the concern of kind of the intermittency and solar and wind, it's important to understand whether your utility provides what's called net metering. And in general, what net metering is an arrangement which the utility customer has a generation resource and sells renewable energy that it produces but doesn't consume. So anything on top of what that entity or that building is consuming back to the grid, sells it back to the utility. And you can think of the name actually comes from when old electric meters actually ran forward when you consumed and ran backwards as energy was pushed onto the grid. So in these, what a net metering tariff or rate does from the utility is the customer receives a credit at the same value that it pays for electricity, and they can apply that credit against their total bill for energy in a month or in a year or a week, however the utility divides up those pay periods. So these are really important because they allow the customer to receive the full credit for the energy that is being produced. Essentially, 1 kilowatt hour of energy produced is the same as 1 kilowatt hour of energy consumed. Another key concept to be aware of is this word interconnection. And this is the process of actually connecting the energy generation facility to the utility grid, that actual physical connection between the solar panels on a roof and the larger distribution or transmission grid. This usually involves an application and a process of the utility to get permission to interconnect and then entering into an interconnection agreement contract with the utility. Another concept to keep in mind for renewable energy as it relates to housing is this idea of being a net zero facility. So net zero relates to the goal of producing enough renewable energy on site or associated with the site to meet the building's entire gamut of energy needs. This is generally easier to do if a building is both energy efficient and all electric, since as long as there's net metering, technologies like solar and wind can be used to meet a building's entire electric need. So some other things to keep in mind, especially as it relates to net metering, as we talked about, is what the average, what your electricity costs are. Here's a graph of just some select states and what the average price for electricity would be. As you can kind of see, the more you pay for electricity, the more beneficial that electrification is going to be, and especially if you have that net metering where you're getting a credit for every kilowatt hour that you're putting back onto the grid. And here's this same graph just for commercial rates. They tend to be a little bit different between commercial and residential rates. I think the cost of electricity per kilowatt hour in your state, in your utility territory is important to know, because this is what's going to make the entire difference on and determine the level of savings that you'll see from installing solar or any other renewable energy resource, any renewable energy technology. And then on the other side, knowing kind of the amount of electricity that's used is also important in terms of sizing the system, whether it's a solar or wind, that generation resource, and other systems that go along with it. For the most part, you don't want to oversize the energy facility, since net metering typically is only going to allow customers to receive retail credits that match their overall energy usage, and often or sometimes can require, giving away credits, giving away those kilowatt hours that are produced over a certain amount for free at the end of the year if the system's overproducing by too much. But again, it's important to know what your specific utility, what their policies are. These have been changing. These policies, or tariffs as they're called, can still prove beneficial. They might have different net metering rates or other kinds of rate structures that you can take advantage of to kind of avoid that problem. I'll go back to John to talk about some additional programs on capacity.
Great. And actually now I think we're right about at the hour. So why don't we take, and we're actually a little ahead. So why don't we take a 15-minute break and kind of have about 45 minutes or so of energy stuff, and then we'll come back tomorrow and finish out the energy and wrap things up. So thank you very much. We'll see you in 15 minutes. Hi, everybody. We're back now to begin discussions on the various programs to help finance energy projects for housing, basically. So the first basically subtopic we'll be discussing is programs to help you build your capacity so you can pursue these projects. So there's funding available from both the Department of Interior and from HUD to help you develop, basically knowledge in this area and some legal and other infrastructure so you can develop projects to benefit, the housing, tribal housing, and the reservation in general. So I'm going to talk about those two programs at this time. And there's basically two Department of Interior grants. There's the Tribal Energy Development Capacity Grant, which, as its name indicates, is to help build up tribal capacity so you can develop energy projects in the reservation. And then there's also the Energy and Mineral Development Program grant, which basically provides money for feasibility type studies for energy as well as mineral development projects on the reservation. Then secondly, there's the HUD ONAP Technical Assistance Program. That's what you're in that right now, essentially, more generally, at least for a group TA. But we'll talk about how the TA process can be used for an individual, typically now on reservation again, TA, that can help explore, what exactly makes the most sense for your housing authority and perhaps for your tribe in general in terms of pursuing energy projects, taking into account some of the things that Mark had talked about before, basically what are the energy rates you're paying, and what is there net metering on the reservation from the local utility, or is there something else that makes some sense to participate in some kind of program so that if you develop energy projects, they're going to be productive for the tribe, the housing authority, and the members, meaning that they're going to, as close to the full value of the energy in retail rate terms, so that retail rates will benefit and lower the energy costs for the members and for the housing authority and the tribe if they're participating in the program. It also go over things like, what kind of grants are available, what kind of tax credits are available in a more kind of detailed way than we will today. That'll be focused on what's best for your reservation. So we'll go into that too. I'll include a link. There's a link in the slides, and we'll include it in the chat also. So in case you want to pursue that, it's a real simple program to apply for, and we've worked through it. I think it's real valuable because you can really get a focused plan for your energy projects. So I'll first though talk about the TEDC program, the Tribal Energy Development Capacity Program. That's again available from Department of Interior. That Looks like, sorry, just checking out any chat here. I think we're good for right now. This is available through the Division of Energy and Mineral Development within the Department of Interior, and they provide this grant annually, the grant opportunity annually, basically to folks, to tribes. And really the purpose is to, develop basically organizational, managerial, and technical capacity to be able to develop energy resources on the reservation. So what that means is they focus on providing kind of assistance as the tribe builds up its kind of business / utility expertise, and as it establishes its regulatory environment to help encourage the development of energy resources on the reservation. As we go through this, I'll talk about some of the elements of the available grant that we've worked with tribes to get and how it's been helpful to them. Excuse me. So basically, the financial assistance is available to either establish a business entity of some sort, or some kind of organizational structures that will help energy development. A lot of those can be regulatory in nature too. So it can be also to develop or enhance key regulatory, ordinances and things like that the tribe would have that would help energy development. So the eligible activities in particular include the following. One is to develop the legal infrastructure for any type of tribal energy business. So if you wanted to develop, and this could include things that go beyond housing. If you want to develop, the tribe wanted to develop a very large energy project on the reservation and wanted to develop a legal infrastructure for that energy business. Let's say it had a lot of land in an area that's good for solar or wind or hydro or whatever. You could get funding to help set up the initial business infrastructure, legal infrastructure for the business that would own and operate that system. And related to that, you can establish, also similarly an energy focused corporation under tribal or state corporation code. So you could create like an LLC or a corporation that might be under tribal law or might be under state law, that would be the entity that would develop the energy resources. Likewise, it could be under federal law, like a Section 17 corporation. If you wanted money to help establish that, you could do that as well. So a lot of can use it for development of business structures to develop energy on the reservation. And then it can also be used for developing and enhancing tribal policies, ordinances and codes and regulations regarding energy resources. We actually worked with the tribe to get funding for it to put together its right-of-way codes with respect to energy on the reservation, and that's what they use then as part of their legal strategy to get substantial fees from the utilities, the various utilities that are on the reservation. We've used that for a couple tribes for their strategy there. So that can be helpful for that kind of stuff too, as well as ordinances that might help promote energy development on the reservation of a certain type. If you wanted to have more solar development occur, especially solar development might be owned by non-traditional utility entities, you could develop codes that would help that occur as well under this grant. We noted before the importance of a Hearth Act ordinance for leasing. This is one way to help pay for that. You could seek funding under this to develop a Hearth Act ordinance that would help energy projects, but that will also help other projects too, like your low-income housing, tax credit projects, and other projects on the reservation that would be owned by entities that are not essentially the tribe itself or the housing authority itself. So that's one way to get funding to create that ordinance system as well. You can also use it to develop a full tribal utility authority. So if the tribe was interested, let's say, in actually taking over the lines, electrical lines in the reservation and perhaps other features, and be with the provider of electricity to the members, this could be used to help establish that utility authority. And it could also be used to adopt a secured transaction code, which is the same kind of stuff that we talked about towards the beginning of developing codes that are more business related on the reservation too. So it really, so it's a wide scope grant. It can be used for things that would help out non-energy stuff on the reservation as well as energy stuff, and it could help out housing, like through the Hard Act ordinance as well. So it's a great opportunity to think about if you want to build up that kind of infrastructure on the reservation, if the tribe does or the housing authority does. This is as for the 2022 announcement. They also had elements that related to addressing heat and cold waves, emergency responses to that. That I think was put in place in large part because of the deep freezes that occurred throughout the country last year, especially in like the southern Midwest. You might call it the Texas on up to the through Missouri in that area, which caused a lot of problems. So building up capacity for that kind of stuff too, they're looking at. The grants under this can be pretty big. They can range up to $1 million, but then this one has no cost share because it's more of a planning type grant, or it's not actually building a project. And that's the way it oftentimes is for those kinds of grants. So it can be a really valuable grant, especially again if you're looking to build up some infrastructure. If you wanted to have a right-of-way ordinance, said to try, why don't we have this because it could be an ongoing income source for the tribe. That'd be great use of it. Also for things like a Hearth Act ordinance that would allow for more low-income housing and other development on the reservation might be a great use for it too, even though it's not necessarily so much energy related. The second kind of bigger grant opportunity from the Department of Interior is the Energy and Mineral Development Program. Again, it's an annual grant opportunity, and it basically focuses on providing financial assistance to tribes and to LIHTCs as well, Indian LIHTCs that have trust land, to evaluate and kind of develop basically the energy as well as mineral resources on the reservation. So it's both energy and mineral. We're obviously thinking more about energy right now, but just so you be aware of it, it can be used. If the tribe has mineral resources on the reservation, it can be used for that too by the tribe. And so this opportunity or this grant provides funding for looking at these and developing a wide range of basically energy types as well as mineral types. So it can be any kind of minerals. Basically, it could be precious metals, it could be industrial minerals, it could be ferrous metals, it could be other metals too. It then provides funding for a wide variety of energy resources. It's not like a renewable energy grant like some of the other ones we'll talk about. So it could include things like oil, natural gas, coal, and then uranium for purposes of nuclear energy production. But it can also include the renewable energy sources like wood materials, waste materials, hydro, solar, wind, and geothermal. So it's really, if you have, and this is really more for bigger projects, like if you were going to put in place a large-scale geothermal system to provide heating and cooling to, let's say, your governmental campus or a large area of homes, or if you're going to put in a large amounts of solar for for all your buildings, for example, and you wanted to help pay for the planning for that, you could do that way. If you have a significant wind resource and wanted to explore and develop that and have feasibility studies for that, this could be used for that too. And same thing for like wood materials for a wood to energy plant, stuff like that, as well as obviously if you have traditional energy resources on the reservation, those could be pursued as well. So this can be really valuable, especially if the tribe has bigger projects in mind. It might not be as important to the housing authority, to tell you the truth, because of the fact that for housing, it tends to be somewhat simpler in the sense that you might have solar for your homes. We can talk to you about how that might be done under a DOE or other grant to get actually the funding for the solar in the homes, and you may not need this interim step. But for bigger energy projects, for the tribe, this could be really, really valuable. So this grant provides funding for kind of a wide variety of kind of pre-development work on these energy resources as well as mineral resources. So you can do a resource assessment, which might include assessing if you're looking at wood energy projects, the wood resources in the area, the timber resources, the waste wood that could be used for something like that. It could also be used for resource assessment for wind, how the wind occurs in this area, which could include, putting up potentially even towers, something like that, to get better information about the wind, stuff like that. There's exploration studies too. That's probably more for mining, to actually explore to see what kind of minerals are in an area. But it can also be used for things like feasibility studies, to actually put together a feasibility study for, does it make sense to, for example, we worked with a tribe on this for, it was a tribe that had a lot of wood resources, to potentially have a district heating and potentially electricity producing facility for its campus, its governmental campus, using wood. So looking at that, what it would cost, what the payback is, stuff like that. So, and that would also then include, in that case, the economic evaluation that can also be done as part of this for projects. And then also market studies to see if you were, if you're producing the energy and you're not going to use it yourself, how would that be sold? Who could be sold to? What's the pricing for that? And how does that relate to the cost of the facility? And then engineering studies as well for, the engineering work for especially for projects that need more engineering. Again, probably more for like geothermal, district heating, and like waste to energy or wood to energy, meaning wood to, let's say, electric generation, projects that are more complex from an engineering perspective. Not so much. You could do it for engineering studies for solar as well, but that's much more simple. And especially if you're doing a real big facility, it probably would just be part of the project itself. So those are the two key funding opportunities for, kind of capacity building on the reservation. One for more business things, utility things, and ordinances. And the second one, for more feasibility type work for the particular resources on the reservation. And then now I'm going to talk about the HUD ONAP TA, because you're probably aware there's these TAs that occur through funding from HUD. They're typically based on requests from either the ONAP region, I guess, for like this one. These are put together based on HUD ONAP region requests, because they're not just for one tribe, they're for kind of all the tribes in the ONAP region, and then it's usually opened up to anybody anyways in the different ONAP regions, the different tribes and tribal housing authorities. And then there's also HUD ONAP TAs where a particular tribe or group of tribes will ask for a TA on a certain topic. And there's a variety of topics that are all, in my mind, very, very valuable to housing authorities that can be, for which TAs can be sought, and they are sought. One of the categories I think is real valuable is this one, because the ability of renewable energy and energy efficiency to the projects are done right to dramatically lower the energy costs for the housing authority itself, but equally or perhaps more important for the members that they serve, because the members typically that are served are in lower income categories. So if we can significantly reduce the energy costs for the members, you really make affordable housing. So it can be that TA topic can be requested basically, and the TAs are either on site. I think they're becoming more on site now again, given hopefully this is the end of the COVID era, essentially in terms of being really significant. But they've also been virtual recently because of the COVID situation. And the purpose of the TA typically is to develop a specific strategy and plan for your reservation, for your housing, for your members, so that it makes sense in light of the type of utility that serves the reservation, the amount of money, basically the cost of the energy, the net metering and other programs. Like, for example, some utilities have fantastic net metering that not only allows you to hook up a system behind the meter at a house or a building and get full credit for it, but even to have what's called community solar or community renewable energy, or they oftentimes called virtual net metering, where you could have a facility that's kind of wherever you want to put it. You can make it as big as you want, or at least up to a certain size, and you could link up the accounts for the various homes to the project, and they all get full retail billing credit. New York, for example, has something at least very similar to that. Other states do too in some situations. But regardless, you kind of can then know what programs you can participate in, and then based on that, what's the best both kind of system to have. Should it be for each home has its own system, or could it be somehow grouped? Do you need to have battery storage, likely because of the issue of perhaps not having that metering? You want to keep all the energy to use on site, that kind of stuff. And then what are the best programs to take advantage of? The state programs, the utility programs, and then all these federal programs, the tax credits to really hopefully pay for the full system. And this is one area where by grouping different programs together for a particular project can, in this case, especially help to get free or very close to free projects, and where that actually then also save money for the housing authority and save money for the members. So they basically pay for themselves too that way, or provide real financial value to the members in the housing authority. So the idea of these on-site TAs is really to allow for that kind of detailed discussion to occur and to get a definite plan of what to go after, and to be able to talk through in detail, like for instance, on the DOE grant application, which is one of the key applications or key grant opportunities, exactly what you'd include in your grant application, the topics, the issues to address, stuff like that. So this is the link, which actually, Mark, if you don't mind just putting this in the chat, it's probably great for the, for a TA request. You may have done this already in other areas, but it's basically, if you click on this, you'll get directed to just a 2-page TA request. So it's a nice simple form to fill out. And if you include stuff about, wanting assistance regarding renewable energy for housing or energy efficiency for housing, they'll direct you then to the right people to help out, to meet with you and to put together this kind of program, for you, so you can have a definite plan of action to take advantage of it. We haven't yet talked about it, but we'll get into it. There's just a lot of funds available now with a combination of federal funding from the Inflation Reduction Act and other sources, and then the tax credits and the DOE grants and stuff like that. So to really be thinking about what to take advantage of is real helpful, I think. And then if you make the request, then the HUD, and you've probably been through this before in other contexts, or some of you have, at least I think probably, that the HUD then contacts, there's there's LIHTC and there's First Pick, and there will be other providers too that they have under contract, and then they reach out to the subcontractors, and we're one of them, to go and meet with you and figure out a plan of action, kind of thing. So that's it. And then basically, I think I've talked a little before, but the kinds of strategies and plans developed would be, ones that help you kind of think through what are the tribal and TDHE goals in this area for clean energy. A lot of, housing authorities have goals now of, focusing on using only renewable energy, focus on, reducing the carbon footprint towards 0 to 0. They plan to, the goal of significantly reducing the energy costs for the housing authority itself and the members, and then create things in a replicable way so it can be repeated in other housing projects that you own, and then repeated, use the model by other housing authorities. And then if that's the kind of goals you have, or whatever they are, then take into account the specific, locational issues of where you are, who your utility is, what this, if you're in a sunny area or not, if it's for solar or windy area or whatever, what seems to make sense technology wise, and what seems to make sense in terms of the various utility provider rate structures and tariffs, like Mark noted. Do you have net metering? Do you have something even better than normal net metering? What do you have to take advantage of, and what needs to be done to make this work? And then also then talking through the better various in more detail. We'll be talking about this in a fair amount of detail now, but really kind of identify what makes sense for you in terms of federal funding availability, grants, as well as tax credits and other incentives, and then state programs, and then utility programs that might be available in your area. Just how you could kind of stack those up to fund your projects. And so that's it on stuff that relates to, just checking out the time, the kind of grants to get ready to go, essentially, or to build up your capacity to be able to go on projects. Now, what I want to talk about is the grants that are more focused on going, focused on developing energy projects on the reservation. So the grants I want to talk about, first one we can kind of breeze through because it's the ICDBG, and that's the kind of, all-purpose grant that can be used for solar and solar plus battery storage and energy efficiency for that matter as well. It can be really valuable. The second one is the DOE Office of Indian Energy grants that are available. And there's ones that's available right now, but the date is kind of closing on that. That's the one that's out now is due February 9th, which is obviously getting closer and closer. But they just announced they're going to have another one. I'll talk about that as well. And that one they have actually more funding available for. So I'll talk about that a little bit as well. The announcement just came out this week on that. And then we'll also talk about the Rural Energy for America program. It's the REAP program. That's one that has been around for a while, but has been kind of supercharged now that there's a lot more money because of the Inflation Reduction Act. And then we'll also talk about new grants that are available on the Inflation Reduction Act that were not available before, and those are very significant as well. Both things that are focused directly on tribes and other things that are not limited to tribes but can apply to tribes as well. And then finally, because we're moving into an age of EVs too, and where you probably want to start thinking about that in terms of your housing, having charging available, money available under the Infrastructure Act, which is the bipartisan essentially version of the infrastructure. So the Inflation Reduction Act, is, to be clear, is the one that was passed most recently by the Democrats only, and so it's a little more focused on green energy stuff, a little more focused on labor issues and stuff like that too, which we'll talk about. And then the Infrastructure Act, which is a bipartisan act, but does include a very significant amount of money for EV charging. And just to let you know about how that works too, because your tribe may want to take advantage of that. It may be important for you if it's occurring to make sure that there's charging available near your home. So the members can take advantage of that too, especially in light of now. And I think one thing that Mark pointed out, which is real relevant there, which may not be that obvious, is that electric vehicles, although they cost more to start out with, although on the other hand, the prices have there's been announcements of significant reductions occurring in the industry. I think because a lot of the logistical problems with battery production and energy in cars in general are starting to subside. So there's starting to be a wave of reductions in prices of them, but also because there's incentives now that we'll talk about a little bit that are available for used electric vehicles too, and then which brings down the price of those as well. So making those affordable as well as helping to make at least new vehicles somewhat affordable. But then the operating costs of these vehicles are very, very low, and so it's important, I think, to be thinking about this issue going forward, because as more used vehicles become available and as the prices continues to probably decline on these vehicles because of improvements in the battery technology and the logistical problems going away, it'll be very valuable to your tribe and the members and the housing authority to be at least connected that way, because you might be able to reduce your operating costs in your vehicle to just a fraction of what they are now too, which long term will be very valuable to the tribe, the housing authority, and the members. So with all that, let me just start again with the various grants that are kind of key ones to be aware of. The first one is one of our key grants in general, as you obviously are aware, is the HUD ICDBG. It's obviously focused on low to moderate income folks, so you have to make sure you're tied that way into it. And you have the same issues of, at least 51% of the targeted population. If it's a single family home, it's got to be everybody. It's got to be the family that's there, because there's only one there in a single family home. But making sure it's targeted that way, so you have to think about it in that light. Although obviously with your HUD homes, the residents are generally that level anyways. So ICDBG can be used for energy efficiency. What this relates to is that there's a prohibition in general on using ICDBG for equipment. But there's this exception in the regulations that allows it to be used for energy efficiency, which can be really valuable if you're taking steps to rehab homes. So you could do under a rehab project for homes, you could have one that's really focused on energy efficiency. And so we've worked with one of the projects we worked on was with a housing authority where I think we talked about this a little before, where it was to really do energy efficiency and indoor air quality improvements in a large number of their homes. I think it ended up being about 150 homes. By using this grant and by using leverage funds from the state, because the state had a good program for energy efficiency and other improvements to homes that where there was lower income folks in them. So that really allowed for a great use of leveraging on both sides. Basically the federal money leveraged the state and the state money leveraged the federal. And so that can be really valuable for you if you're thinking about, hey, we got some older homes, we got to make them both nicer and just better in general, but also more energy efficient. This can be great use of the HUD funds that way. But it also includes, in particular, solar energy equipment. So a number of tribes have used this grant to fund solar energy, and we've been involved in a number of them that have done it. Use the grant money in combination with tax credit funding to pay for the full project, basically, and meet the leveraging, kind of requirement to meet the maximum points there. So this is another important use of the HUD grant. And so here is with that same chart we looked at before. So just noting that the money is actually allocated by ONAP regions in this case for the grant. So you need to be thinking about, it's really more like you're on your own mini grant region with the folks in your ONAP region and essentially competing against them. So you're just going to be aware of that. And then here's the amounts, and the maximum amount is $2 million. That could provide, especially with integration of tax credits, which we'll talk about later on, and potentially state funding, could provide solar for probably it could be 150 or more homes. So it could be quite a project done to provide solar, and potentially providing solar that essentially wipes out the energy bills if you're in a good net metering area for your members, except for the kind of the fixed fees they have to pay on their kind of hookup charges for their utility. So that can be very valuable, and a number of tribes have taken that approach to really dramatically lower the gross costs, or the total costs for the residents in those buildings. And then in the meantime, you could also use that to put solar on your trouble housing authority buildings as well and lower your costs. That's what a number of tribes have done. These are the factors. I won't go through them again, but just kind of they're the same factors obviously we looked at before for ICDBG in other contexts, and it's just important to be thinking about those and on top of those as you're doing your application. And this is just the same as before in terms of the funding availability. So that's one key grant is the ICDBG, but it's also key, as I'm clearly aware, for other purposes too. So because of that, you might say, well, ICDBG would be great for this area too, but we need it in some other area, or even the tribe is saying we got to use it for something else. Or your tribe is saying that. But there's another grant that's only for energy, and so provides a great opportunity without kind of having the opportunity cost of losing use of it in some other area. And this grant is the DOE Tribal Energy Grants program. And one of the subsets of that is for, at least this time around, is for what's called clean energy technology deployment on Indian lands. This round, there's also a separate one for electrification of buildings that are not electrified, and we'll talk about that a little bit too. Next year, or actually technically this year again in 2023, most ones due in 2023, there'll be another round that has actually $50 million that's for both combined, but probably most of the money I'm assuming will go towards clean energy, because every tribe could use it for that, and electrification is only for a limited set of tribes that have issues with buildings that are not electrified. But this one, the announcement for it came out in November of last year, and then they're due on I think it's Friday, November 9th, but on November 9th at 5 p.m. So I'll talk about this, what the categories are, and they're important categories, not only for this round, but probably for future rounds too. This is what they've been kind of using to kind of tweak this a little bit, somewhat generally each year, but not very much. So it's good to know these different categories and what you could go for money for. Topic area 1 is for clean energy generation systems. So like facilities like solar or wind or whatever that produce energy, and or energy efficiency measures for tribal buildings. So this would be where you're doing stuff on one or more tribal buildings, and you'd either have your project be, let's say, a solar project on that building or other clean energy generating systems, or energy efficiency measures. So maybe putting in substantial energy efficiency improvements in that building or buildings, or doing both together. So what they do is they divide it up into 3 subcategories, then one for, things that where you're putting clean energy generating systems for one or more buildings. And the second thing is energy efficiency measures for one or more buildings, and then energy generation systems, and energy efficiency for one or more buildings. So they have these different subtopic areas too within that. The second major area, and this is what a lot of tribes have gone after and have implemented in tribal housing authorities, where they want to put, let's say, solar on a lot of buildings or serving a lot of buildings. It could be like all the buildings, all the administration buildings for the tribe, or it could be a large number of tribal member homes, or perhaps both together. Various tribes have, had those kinds of projects, and they've, done well. There's a lot of awards in that area too. And so they have 2 subtopics within this. So the one is for either a large facility or a lot of little facilities, or a lot of facilities that would be clean scale, community scale, clean energy generating systems, like, again, let's say solar at a whole bunch of locations, or a big solar system if you have community solar available that would serve a lot of buildings. Would be subtopic 2A. 2B is if you did the same thing, but instead of using generating systems, you put in storage systems, so like batteries, basically. So if you had a number of buildings that, let's say, first of all, already had solar, but now you say, I want to put storage there because you can better protect the buildings, better control the use of the energy in the buildings, and perhaps reduce your energy use charges because of that. Some tribes will now be going for community scale, so having it in multiple locations or serving multiple buildings, but using instead of adding on generation, adding on battery storage or other kind of storage devices. And then the third category is for integrated systems, basically, which would be typically the most typical one would be probably solar plus storage. Where you have some kind of generating system. It could be wind, it could be something else too, but something plus some kind of energy storage system that then allows the building to operate autonomously, so that it could, if the energy went out on the grid, the building could still operate because it has a combination of the energy production from the solar plus battery storage. So it creates its own what's called microgrid that serves that building or set of buildings. And you can either seek that project under something where you just kind of target one or more buildings to do. That's the powering essential tribal buildings subcategory, or you could be where it's they call tribal community resilience, where you're putting it, let's say, throughout the reservation or on a lot of buildings. So one is for a more targeted approach where you're addressing one or a few buildings. The other ones where you're addressing a lot of buildings, basically, through that. And basically, we worked with tribes that have sought in all these different categories. So I think that each one can be valuable for whatever context makes sense for your tribe. Whatever in your housing authority, what makes the most sense to pursue, and that's why it's helpful to kind of think through. What there's all these different opportunities. Which one really makes the most sense for us? And for example, it might make more sense to concentrate on area 3 if you don't have any generation facilities right now, but you're also in an area that has not very good resilience and or doesn't have good net metering, so we can't take advantage of the net metering program. So we need to keep the energy on site or we want to. So we're, using it against our own energy usage and not selling off the energy cheaply to the grid. So the ability to kind of think through those things help you to pick out what's the best category to be in for yourself. And in this, for these grants, there's, for the one that's out right now, there's 20 million in federal funds available. For the one that's coming out later this year, there'll be $50 million, but it'll also include unelectrified buildings. But it'll be a lot of money available. It's a lot of money available now, frankly. It's higher than it's been in the past, but it's really gonna be a lot of money later this year as well. So it's good that, if you're pursuing one now, it makes sense to get it in. If you don't receive the grant for some reason, it makes sense to probably think through the project again and see if you can submit it for the next round this year. And if you're not working on it, but you want to do energy projects, this is probably one of the most important grant programs to be aware of, just in general, and especially given the increased funding. Because of the increased funding, there's also more money available per project. There used to be actually that for topic area 1, again, which is that more targeted thing on this one or a few buildings, that the cap I think was $500,000, then it went to $1 million, and now it's up to $2 million. For the community scale, it used to be $1 million, and then it went up to $2 million, and now it's at $4 million. So the amounts available keep on growing, which is great in my mind, because it allows tribes to do bigger projects that really meet the needs of the community, to both lower energy costs and to meet tribal goals on clean energy and things like that. So there's a lot more money available. In fact, those dollars, what I'll probably do is as we go along, I'll kind of tell you what's different between the one that's out right now and the one that's coming out shortly in the future. The one that's coming out in the future has actually got higher caps. So it's 2.5 million for topic area 1 and a topic area 3A, and then it'll be $5 million for where you're doing more community-wide stuff. So the amount of money keeps on growing, which allows you to have bigger and bigger projects, and therefore meet more of the tribe's needs and the tribal housing's needs. And then the cost share, it's gotten a lot better actually recently as well. So what happened was, historically it's been a 50% cost share. So you had to be, if you got $1 million grant, you had to do it. You had to have a project that was at least $2 million in size and bring in outside funds for that. And it was non-federal funds. That's one thing about the DOE grant. It's unlike the HUD grants, like the ICDG, for example, allows you to use federal funds typically as cost shared, but it can't be the ICDG funds itself. Here you have to have your funds be non-federal cost share. One good thing is that DOE has recognized that NAHASDA money for your block grant is allowable as a non-federal source. And secondly, the thing that's good is that they recognize that tax credit funding can be considered a non-federal source too, and we'll get in that when we get in the tax credit portion of the discussion. But they've also reduced the cost share significantly. It used to be 50%, now it's 20%. So if you have $1 million project, 800,000 could come from DOE. And then if you meet the requirements, which are based on the poverty rate and or median household income of the tribal community, you can actually have the cost share reduced to 10%. So there's certain things you have to check out. You're kind of locked in. It also allows you to explain, you think the data is wrong about your tribe, but it basically requires that you meet those kind of categories, get down to 10%. But the good news is that there's also these enhanced tax credits that are available that actually, are more than the 20 or 10% cost share. So you could potentially receive more money back and then do more renewable energy projects that way. So the good news is that the cost share has gone significantly down and the tax credits work out well, and there's other potential funding sources to take advantage of as well to make these projects, work out as to be basically fully paid for. Now we have the key requirements for the application. I'll make us do this slide and then stop because we're almost at the end of the hour now. So there's some key things that you need to think about if you're doing one of these projects. And so it's helpful if you can think about it beforehand, like if you were thinking about it, I think I'll apply for the one that'll come out this spring or summer. I think the DOE said it's going to be in spring, but it could be, you know, anywhere coming out, I guess, after spring begins. But to be able to start thinking about what are your projects that you might pursue, and what's the information we need to start collecting. So it's helpful to kind of know these requirements, at least generally, so you can start to think about that, and develop your plan for your specific plan for your projects. Excuse me, there's two key kind of longer, or at least fairly long documents you put together that are the ones that get scored, which are the technical volume, and we'll talk about the elements of that, and the work plan. So what you're going to do to implement your project. Those are the two that kind of, you know, get mentioned before, get scored, and that are kind of the heart of the application. There's a lot of other documents you got to submit too besides that, but another thing that you have to have available to go is, if you're doing efficiency projects, you need energy audits to show, you know, what the energy usage and how that can be reduced. Or if you're doing, let's say, solar or solar plus storage or any other kind of generation, you need to have a feasibility study. The good thing is that with especially with solar, the feasibility study is really pretty simple, because if you can just work with anybody who has some technical input, basically, you know, any kind of solar developer or solar folks we've worked with in the past, or we kind of had a tribe that partnered with a solar contractor of some sort that could run what they're called helioscope or PV watts models, and they just simply, what they do is they basically place solar facilities, you know, in a certain location through a computer model, and they have it. They indicate which way it'll face. Is it face south or east or west or whatever, and then what is the angle of the panel, and then based on that, it basically spits out relatively quickly, the expected production of the system, and can be used to make the system to have basically a feasibility study, kind of ready to go feasibility study for the project. So with that, I think we're right at the hour. If that makes sense to stop now, and then we'll just reconvene in the morning, and we'll work to get through the rest of the energy stuff, as well as make sure everybody's on the same page on what we covered so far. So thank you very much, and have a great afternoon.
Thanks, everybody. See you tomorrow.